Can you hear me, bro? Yeah.
Hello.
Oh, can you hear me, bro? Yeah.
Yeah, bro, sure.
Okay. Like if you could speak a little louder, it would be great. I can't hear you clearly. Okay.
Can you hear me?
Yeah, like a little more louder, maybe.
Okay, bro.
Okay.
Okay.
Yeah. Now it's fine.
Okay.
Okay. And can you see my screen? Yeah.
Yes.
Okay. And you can record if you want to.
Okay, sure.
Mhm. Okay.
And bro, one more thing I
Yeah.
have to say.
Okay.
My English will be a little bit worse, so you
No
have to
problem,
manage
bro.
at some
Yeah.
point.
Yeah. Don't worry about that. Don't worry about that. Okay.
While
Yeah. You can start
while it
recording,
comes
bro.
to
Because
typing,
yeah.
it will be okay for me.
Okay.
But when it comes to speaking, it's a little bit worse.
No problem.
Okay, okay.
Okay, so did you start recording? Let's get started.
Yes, bro.
Okay. Yeah, because I won't be recording it, so if you record it, you can get it, or else you won't get a recording. Okay.
Okay.
Okay, then let's get started. So you know the basic smart money stuff, right?
Yeah.
What order blocks are, what liquidities, imbalances, and stuff. Yeah.
Yes, yes.
Okay. So now let's get started with this. Now, do you know about the strong highs and the strong lows, and the weak highs and the weak lows? Yeah.
Yeah.
Yeah, now for us to consider it as strong high, price has to do this. It has to take out liquidity from a previous high and then break structure. Simple. Okay, it has to do a run on stops and then break structure. So if this happens, this high will be considered as a strong high. Okay, that high will be considered as strong high. And same thing, for it to be a strong low, price has to do this. Okay, it has to take out liquidity from a previous low and then it has to give you a breakout structure like this.
Yes.
Okay, so if that happens, this will be considered as a strong low. Okay, that will be considered as strong low. Now, what happens in the market is something like this. Now, for now, I'll just draw this out to you, and later let's get into charts. Okay,
Okay.
yeah. Now, this is what happens in the market. So let's say we had a stop hunt, a breakout structure. Price might retrace and then give you another breakout structure like this. Okay, might give you another breakout structure. So now you can see price is clearly in a downtrend, right? Creating lower highs and lower lows. So if someone wants to re-enter the market, what would they expect? A lower high and a lower low, right? This is what anyone would expect. Okay,
Recording in progress.
yeah, this is what anyone would expect, right? A lower high and a lower low. So first thing, smart money traders, what would they do? They might look for a point of interest in these areas, set their limits here, stop losses above these highs, targeting lower prices, right? This is what the smart money traders would do. And even supply and demand traders, because this is what they call a rally based drop. So they might call this a supply zone and then set their limits here once again, stop losses above these highs, targeting lower prices. Okay, this is what they would do too. But then again, not only the smart money and supply and demand traders wants to enter the market here. Okay, we have trend line traders. Okay, we have trend line traders. What they would do is they'll wait until the third touch into the trend line like this, and then stop losses above these highs, targeting lower prices once again. This is what they would do, right? This is what they would do. They will expect a move like this or something like that. Okay, so this is what they would do. And then again, we have break and retest traders. Okay, break and retest traders. What they would do is, like, what are the confirmations they use? Something like a bearish engulfing candle, right? Once they find out a bearish engulfing candle, they will sell this thing, stop loss above these highs, targeting lower prices once again. This is what they would do. Same thing, we have broken support turning into resistance. We have SNR liquidity. Okay, a broken support turning into resistance. What they would do is once they find out, once they find out a bearish engulfing candle, they're going to sell this thing, stop loss once again above that high, right? Once again above that high. Then we have breakout traders. Because why? What have the breakout traders been taught? So if price breaks structure, if it retraces and gives you another breakout structure, the breakout traders are going to have their buy stops above this high. Okay, buy stops are going to be placed above this high, because the reason is anyone knows that if something like this happens, it's going to be a breakout structure, right? It's going to be a breakout structure. So the
Right.
breakout traders, what they do is, now since they want an early entry, they're having their buy stops here, because they know that in case if that happens, price can keep going higher. Okay, so that's the thing. Now this right here, now let's look at this. Okay, how much of liquidity is resting above this high right here? A lot, right? all types of all types of traders are trapped above this high, right? All types of traders are trapped above this high, like the yeah, 90% of the retail stop losses are right above that high. See that? Right above that high. So like if we call ourselves smart money traders, and if we do something like this, we're just adding into that pool of liquidity, right? Our stop loss is also with that liquidity. So you can't do that. So if you're a smart money trader, you have to be thinking like thinking like the smart money entities. Now, what are the intentions of the smart money? Is to take out the retail stop losses, right? Is to take out the retail stop losses. So where are the retail stop losses now? Right above that high. Right above that high. So knowing that, you're not going to sell it here. You're going to look for something above that. Okay? You're going to look for
So you are
something
saying
above that.
that
Yeah,
this will become an inducement, but it's
exactly.
not a valid structure high, right?
It is not a very structural high. Okay, it is not a structural high. Now once we get into charts, I'll show you why it's not a structural high. Okay, yeah. Now people are induced into believing that this high right here is a break of structure point. See that? Inducements. People are induced into believing that this right here is a break of structure point, and another set of people are induced into selling from these areas, right? Selling from these areas. Now, like, that's the thing. Okay, the inducements, those are the things that matter the most. Okay, those are the things that matter the most. Now price might come up, and in these areas you might get good reactions. Why would they do that? Okay, only to like get you hyped up, nothing else. Because you know how we get the confirmation entries, right? Now when price taps into this point of interest, you might even get something like this on a lower time frame, a lower time frame breakout structure.
Yeah.
When price taps here, why are they doing that? Building up more and more liquidity. Now then what people would do is increase their risk and then reduce their stop loss on a lower time frame point of interest like this, right? Because why? The trade is confirmed after the breakout structure. So they might have their stop loss above these highs now, having the same targets like this. Why? That way they can increase their risk to reward ratio, right? Okay, so this is what they would do. And then again, some people might look at this as a trend line forming. Okay, some people might look at this as a trend line forming, and surprisingly, all of these areas will get respected for a while. Why would they do that? Building up more and more liquidity. See that?
Yeah.
More and more liquidity is getting built up. This is what we call engineered liquidity. Okay, engineered liquidity. And then what happens? All of a sudden, bam, will go straight through it, and all of the sellers will get stopped out. Okay, all of these sellers will get stopped out. And then what we should understand is that if they want to go lower, they're going to induce buyers into the market first. Okay, they're going to induce buyers into the market first. Now look at this. Buyers are induced into the market in the form of buy stops. See that? Buy stops are activated now.
Yeah.
Because why are they doing that? Because only if there are buyers in the market, they will have their stop losses below a low, right? Can you understand it? Only if there are buyers in the market, the stop losses will be below a low. Now, what happened is, now when price broke above this high, buy stops are activated, and then another set of people would look at this as a breakout structure, and they will expect moves like this, right? They will expect moves like this. So now, where are the stop losses placed? Right below this low, right? Right below that low. Can you understand it? Like they might look for order blocks or something from this area, set their buy limits here, stop losses below these lows, targeting high prices. This is what people would do, right? This is what people would do once they look at this as a breakout structure point. Now they will be expecting moves like this. Okay, so this is what they would expect. So that's the thing. This high right is what we call a major inducement, because why? Like when it was here, a lot of stop losses were getting built up above that high, but when it broke, now where are the stop losses? Right below this low, right? Right below that low. So with this high right here, what they did was they built a cause for lower prices. Now they have a reason to do this. See that? Now they have a reason to run below these lows. Okay. So now, yeah, price can go up. It will sweep all of these stop losses, activate the buy stops, and then they will quickly push price back down. Okay. This move will be very quick. And in these areas, once again, you might get reactions. Why? building up more liquidity. Okay, more and more liquidity is getting built up, these fake trend lines forming and all of that, and then where everyone will get stopped out. Okay, so this is that entry you should always focus on getting. Entry above the liquidity. Okay, entry above the liquidity. So you can set it here. Stop loss. The safe place for your stop loss is always above the strong high. But if you do not like the risk to reward ratio, you can put it above the point of interest and then target lower prices like this. Okay, and now the reason I'm referring to this as a point of interest is because now this doesn't have to be an order block all the time. Okay, this could be an order block. Yeah, this could be an order block, or else this could be a breaker block, or else an imbalance close price action. Okay, anything. But what makes it high probable is the liquidity that is resting below it. Okay, that is the main thing. That is what makes it high probable. So can you understand it? Yeah.
Yeah, yeah.
Yeah, this is what happens in the market. Okay, builds up liquidity, takes it up.
Can you please explain what is a breaker block? Because
Ah,
I
yeah,
may
I'll show you.
heard about it later.
Okay, I'll show you. A breaker block is something like this. Now, this is the formation for a breaker block. Once again, something like this. Okay, something like this. So now this whole area would be an order block on a higher time frame, right? Last push up before the push down. See that? Last push up before the push down. So this whole thing is an order block on a higher time frame, right? It's an order block on a higher time frame. So this push up started only to take out this liquidity, right? From this high. Okay, so there will always be a bearish candle here, the last push up before the push down. Okay, so you don't have to mark out this whole area. On a lower time frame, you can see a breaker block in this area. So I'll show you. Okay, there you can see a breaker block in these areas. Okay, so now keep in mind this is the formation of a bearish order block. I'm sorry, breaker block. Okay, this is the formation of a bearish breaker block, and you can expect moves like this, like this. Okay, yeah.
Simply speaking, it's a supply becoming a demand or a demand becoming a supply.
Yeah, I did not learn a lot about supply and demand, but yeah, but it's more different. Okay, the breaker shows you where the money is actually. Okay, it's not a supply or demand zone. Okay, the ICT breaker, it never fails. Okay, the proper ICT breaker will never fail. Okay, so keep that in mind. And yeah, same thing for a bullish breaker block. So the bullish breaker block will be right here. Okay, the bullish breaker block will be right here where the structure got broken. Right here is where the structure got broken, right? So this is where the breaker will lie like this, and then you can expect moves like this. Okay, you can expect moves like this now. Yeah, because it's just a higher time frame order block, but if you go to a lower time frame, it's gonna be a breaker block. Let me show you a good example. Yeah, maybe here. Okay, see this? This is an order block, right? Last push down before the push up. Okay, last push down before the push up, but what happened? Straight through it. Okay, straight through it, violated. Now, what's the formation I told you? Like this, right?
Yeah.
See that? So here is the breaker. Okay, here is the breaker, and where does price come into? Price will come back. Oh, shit. Okay, price will come back right into that, and then it drops. See that? It'll come right into the breaker. Okay, so that is what we call the breaker. Now, this whole thing right here is a higher time frame order block, right? Last push up before the push down. See that? If you go to the 4 hour, that's an order block. See that? Last push up before the push down, that's an order block. But if you go to a lower time frame, you can easily refine it to the breaker block like this. Okay, simple. Can you understand that? Yeah, that is the breaker. Okay, that right here. Now, this is the formation you need all the time: a stop hunt and then a break. Okay, so this is where the breaker is.
Someone
Okay,
may call it as a quasi model.
yeah, you can even call it as a Quasimodo. Okay, but yeah, now in Quasimodos, now this is the level they're expecting for price to return, right?
Yes.
Okay, something like this. But yeah, we're not expecting that. We're gonna expect the breaker. Okay, so yeah, now these Quasimodo, these QMLs, these imbalances, hidden bases, and all of that, if they line up in the same place, it's gonna be very high problem. Okay, like very, very high problem if all of them line up in the same place. Okay, but yeah, that's a bullish breaker. I'm sorry, a bearish breaker. And let me show you maybe a bullish breaker. Oh yeah, here. Yeah, right here. See this thing? This is a this is an order block on the daily, right? Last push down before the push up. But if you go to the 4 hour, see this? What's that? A little breaker. See that? A little breaker block right here. Can you see that? So that becomes your point of interest. Okay, that becomes your point of interest. And where does price come into? Right into that, and it goes. See that? A little tap, and then it goes. Okay, so these high time frame order blocks are always lower time frame break blocks. Okay, so keep that in mind. So that's a bullish breaker, and this is a bearish breaker. Okay, so it's clear, right? I hope it's clear. Okay. So that's about the breakers, and you get this thing, right? I hope you understood this. Okay. Yeah. Then that was the first example, and this right here will be the second example. Now price can do something like this. So in that first example, I told you do not look for anything around here, but look for something above that, right? That's what I told you. That's what I told you. But then again, like why did I tell you that? Because a high probable point of interest will have liquidity resting below it. Okay, so now this is the point of interest that has liquidity resting below it, right? Not this, not this. Okay, this is the one that has liquidity resting below it. Okay, so what if on their way up they're doing something like this? You have to always pay attention to how price is pulling back towards your point of interest. Okay, because let's say on their way up they're doing this, they're moving up with compression, they're moving up with compression, and let's say they started building up some liquidity like this. Okay, right below this point of interest. Now what are we gonna do? Okay, I told you a high probable point of interest will have liquidity resting below it. Right now we do have liquidity resting, see that, equal highs resting below this point of interest. Okay, so now this will become a high probable point of interest too, right? See that? Now this will also become a high probable point of interest. Now price can do one of these two things. Okay, they can do something like this. They can come up, sweep this liquidity into this point of interest, and then drop. Okay, that can happen. That can happen. Why? Only because of this liquidity. Okay, only because of this liquidity. Or else they can do something like this. They can go up, give you a false reaction, then even build up more liquidity like this. Okay, they can build up more liquidity and then do this. See that? They can then do this. So this also can happen. So personally, what I would do is I will take this self assured. I will take this self assured, because what if you ignored this liquidity and you were waiting for this to get taken out and this to play out? But what if price comes here, sweeps this liquidity and then drops? You're missing out a good move, right? You're then missing out a good move. Okay, so personally, what I would do is I will take this self assured, because no one out there, okay, no one can guarantee you that price is going to play out of this order block or is this or something out here. No, no one can tell you that. All you can do is see where the liquidity is getting built up and look for the point of interest right above that. Okay, that is what we're going to do. So I will be willing to risk my money here, because like price can drop from here too because of this liquidity. Okay, so what I would do is I will sell it here, and as soon as it starts to give me a reaction, I'll move it to break even. Because why? It was anyway a high risk setup, right? It was a high risk setup because a lot of liquidity was resting above this too. So I'll just quickly move it to break even, because like this is what I would do. I'll move it to break even and I'll monitor price action in these areas. Okay, I'm gonna monitor price action in these areas and see if price is gonna break this counter trend. See that? See, look at this counter trend. Okay, I'll see if price is gonna break this counter trend. So if they break that counter trend, then we can expect moves like this, right? Then we can expect moves like this. But if it fails to break below this counter trend, like if it comes here and does something like this, then I know that price is gonna go up. Something like this can happen. Can you understand it? Okay, so you have to always, yeah, pay attention to how price is pulling back. Okay, and you have to be willing to take a risk in these types of scenarios. Okay, so this will be the second example. Can you understand that? Yeah. Okay.
So we always
Okay.
look for liquidity below a POI,
Exactly. Yeah, that is how we want to
if
see.
there is no
Okay.
liquidity, we are looking for the counter trend action with
Yeah.
help of a new liquidity, right?
Yeah. Now, if there is no liquidity, simply you're gonna wait until this gets taken out. Okay. Now, sometimes it can play off, but it is not high probable anyway. Okay, because remember, these
It's a
clear
defensive
order
play.
blocks are also, yeah, these clear order blocks are also sometimes, okay, now something like a smart money trap. Okay, something like a smart money trap, because smart money concepts are not something new, right? all of the retail traders are using smart money concepts now. Now, like order blocks are more famous than a trend line. Okay, so everyone will be looking to, yeah, everyone will be looking to enter from order blocks. So what if all of the order blocks play out? Then everyone will make money, right? So then how would the institutions make money? That's the thing. Okay, so that's the reason why they give you these fake order blocks all over the place. Okay, so you have to know which ones are high probable. So for that, you have to know where the liquidity is. Okay, you have to know where the liquidity is. Can you understand it? Yeah.
Yeah.
Okay, so this right here is the second example. And same thing, like, let me know if you have any doubts. Okay. Yeah. And this is a bullish market. Price can do something like this. So let's say we had a stop hunt. We had a break of structure and another break of structure here. So now you can see prices in an uptrend, right? Creating higher highs and higher lows. Okay, higher highs and higher lows. So now, what would anyone expect if they want to re-enter the market? A higher low and a higher high, right? This is what anyone would expect. Okay, this is what anyone would expect. So smart money traders, what would they do? They might look for a point of interest from these areas. Okay, then set their buy limits here, stop losses below these lows, targeting higher prices, right? This is what the smart money traders would do. Okay, this is what smart money traders would do. And same thing, supply and demand traders, what would they do? They might call this a drop-based rally, might mark this as their demand zone, and then set their buy limits here, stop loss below this low, targeting high prices, right? Once again, that is what they would do too. And same thing, now we're just entering off a break of an order block. Okay, but what are the other retail traders doing? They are entering the market here too. Okay, see, some people might look at this as a trend line, and they might wait for the third touch into the trend line, stop loss below that low, targeting high prices, right? People will wait for moves like this to play out. Okay, this is what they would expect. So once again, stop losses are below this low. And then we have a broken resistance turning into support. Okay, so what they would do is once they find out a bullish engulfing candle, they'll buy it, stop loss below this low, once again targeting high prices. Okay, this is what they would do. And same thing, we have break and retest traders. Okay, break and retest. So same thing. Once they get their confirmation, they'll buy this with their stop loss again below that low. Okay, and then we have breakout traders, because why? If price breaks structure, if it retraces and gives you another breakout structure, the breakout traders are going to have their sell stops below this low. See that? Sell stops are gonna be below this low. Okay, so now look at this. How much of liquidity is resting below that low? A lot, right? So much of liquidity is resting below that low. So we cannot look for POIs from these areas. See that you can't look for a point of interest from these areas, because why? We know that this will get taken out because there is a lot of liquidity resting below it. Okay, and it was not a high probable point of interest, right? It was not a high probable point of interest. Like this, if you take it this way, this is not a high probable point of interest, because why? There is no liquidity resting above that. Okay, there is no liquidity resting above that. Okay, so what we are going to do is we're going to look for something below it, like this. Okay, we're going to look for something below it, and then let's wait until it gets taken out. So price might come back down, give you good reactions. Why? Only to like get you hyped up, and then might build up even more liquidity like this. So everyone will start buying this thing, fake trend lines forming and all of that. Then all of a sudden comes the right move like this. What are they doing? They're taking out all of the buyers, and then sellers will get induced into the market in the form of sell stops. And then another set of people would have looked at this as a breakout structure, and they will expect moves like this. Okay, so then the stop losses, like they would look for order blocks from these areas, set their limits here. Stop losses above these highs now, targeting lower prices. So we know that liquidity is what drives the market, right? Liquidity is what drives the market. So what did they do? They built liquidity above this high. So now they can do this. They have a reason to go above these highs. See that? They have a reason to go above those highs. So that is what they did. They built up some liquidity. Okay, so this is that entry we're always gonna get. Okay, like this entry above the liquid. I'm sorry, entry below the liquidity, like this, targeting this high, and this move will be very quick. Like you would have seen, most of the time I get tapped in with a wick. Okay, it just taps my entry with a wick and it goes. Okay, so that's the thing. For that, you have to know where the liquidity is. Okay, that is when you can get in with a wick. Okay, because we're getting in with the manipulation. Okay, and then price will quickly go up, and in these areas you might get reactions once again like this. Okay, why? People would have wanted to sell from this area, so they will get all hyped up, and then bam. So everyone will get stopped out. So see, smart money traders, what happened to them? Wanted to buy here, stopped out. Wanted to sell here, stopped out. So then they'll be like, order blocks doesn't work anymore. No, order blocks, they do work, but you have to know where the liquidity is. Okay, that's the main thing. Can you understand that? Yeah.
Yeah.
Okay. Yeah, I hope this is clear. And let me show you a good example of this thing.
So,
Yeah,
how do
very
you
clear.
enter
Yeah.
in these kinds of areas? Will you
I'm
place the
sorry.
entry directly, or will you wait for a certain kind of confirmation types?
No, like most of the time, if my zone is too big, okay, like something like this, then I will wait for a confirmation. Because why? It's too big, right? I will not place my stop loss here anyway.
Yeah.
Okay, so if the zone is too big, I'll wait for a confirmation. Okay, like something like this on a lower time frame.
Okay.
Okay,
So
something
it's
like
like
this
a
on a,
change of character,
yeah,
break of structure, like that.
yeah, yeah, a breakout structure. Let's call it a breakout structure. Okay, this
A break
change
of
of
any
character and
character.
those stuff. Yes, those stuff, just to complicate people. Okay, only to
Just
like
a
fancy
fancy
names,
name made
only
by
to get
Phantom.
people. Yeah, phantom growths. Okay, only to get people into their stuff. Change of character bullshit. Okay, so this is it. Okay, simply wait for a QM to form, a bullish QM to form. That's it. Okay, a bullish QM and inducement by below that pair. That's it. This is the only confirmation you need. Okay, that's the only confirmation you need inside of your point of interest. Okay, so yeah, let me show you a nice example. Yeah, let's say we were here. So now, what can we see as soon as we open the charts as smart money traders? We can see these maybe order blocks. Yeah, you can see order blocks, or as we can see imbalances. Okay, or else we can see these liquidity getting built up and all of that stuff, right? This is what we can see. But what can the retail traders see? By retail, I mean the ones that are using retail concepts. What can they see? As soon as they open the charts, they'll be like, oh, that's a trend line for me. See that? That's a nice trend line. Okay, that's a nice trend line. So what would they do? Okay, what would they do now? Imagine how many people would have wanted to buy it when price tapped into this trend line. Just think of it. Okay, and what would they do? Like, see, every single time price came into that line, rejected, came into that line, rejected without any reason. So, like, some people will be expecting for this to play out, and where will they place their stop loss? Below that low, right?
Yeah.
Below that low. This is what the trend line traders would do, below the previous low. Okay, so first thing we have trend line liquidity below that low. And then we have breakout traders, because why? If price breaks structure, if it retraces and gives you another breakout structure, the breakout traders are going to have their sell stops below that low. Okay, sell stops will be placed below that low. First thing, we have trend line, we have breakout traders, and then we have smart money traders. See this order block? Look at that order block, because what have people been taught about order blocks? If it breaks structure, I'm sorry, if it takes out liquidity, if it has an imbalance left, and if it breaks structure, it's going to be a high probable order block, right? That is what people have been taught. So everyone will be like, all of the smart money traders are going to do this.
Even I would
Everyone will do
take an
this.
entry there.
Yeah.
Even I have also taken an entry there.
Yeah, that's the thing. Okay, so everyone would do this. Everyone would do this, and see, that's a 9 pip stop loss from the 4 hour time frame. So that's not bad, right? So everyone will be willing to do this. Okay, and then yeah, we have smart money, we have trend lines, we have breakout traders, and even supply and demand traders, right? A drop, a base, and a rally. Okay, a rally here and a base here and another rally here. Yeah. Okay, but the thing is, now look how the bullish candle started getting bigger and bigger after this move to the downside. Okay, see, with the imbalances and all of that. So supply and demand traders might call this a good demand zone, set their limits here, stop losses below that low. Now, if you go to a lower time frame, you could even see equal lows. See there? A double bottom. Okay, you can even see a double bottom. And this is most importantly, this right here was an unswept Asian session. See there? This is an unswept Asian session. Now, this is our time. Okay, now this is IST. Okay, this is when Asia starts. Now, yeah, this was on this was on September. So on November, the times were changed because of the daylight savings thing. Okay, like yeah, I think you know the session timings properly because this Asian session will be very important. Okay, Asia is pretty much the guide to an intraday trader. Okay, Asia shows you where the liquidity is. Asia shows you where the market wants to go. Okay, like do you know the importance of the Asian session? Yeah,
No, no, no. I haven't.
yeah. Now, okay, I'll show you. Now, always make sure you mark out the yeah.
I know the timings
What's
of the
that?
sessions, but I'm not aware of the these kinds of things where
Okay, I'll show
lows
you.
and highs get manipulated, all that kinds of things.
Yeah, I'll show you. Now, this is what happens. Okay, this is what happens. So let's say now we know that Asian session is mostly a consolidation, right? Asian session will not move a lot. Okay, it is mostly a consolidation like this. Okay,
Yeah.
so Asia ends at the New York midnight time. Okay, Asia ends at New York midnight time. That is 10:30 a.m. for us. Okay, so Asia ends at the New York midnight time. So what happens is something like this now. There's a set of people called the session breakout traders. Okay, the session breakout traders. Now, like trust me, there are like groups on Instagram, pages on Instagram that teach you these strategies. Okay, session breakouts. So what they are gonna do is they'll have their buy stops above Asia, sell stops below Asia. Okay, because they would think if price breaks out of Asia like this, London is gonna be, or this whole day is gonna be bullish, or is London will continue this move to the upside. That is what they expect. Okay, that is what they expect. So they will have their buy stops above Asia. Okay, they'll have their buy stops above Asia. So after the New York midnight time, what happens is there will be a false run in the opposite direction like this. Okay, what are they doing? There will be a false run in the opposite direction. What they're actually doing is they're inducing bias into the market. See that? Inducing bias into the market. Now, everyone would think, okay, now it has broken out of Asia, so London is going to be bullish, and all of these trend lines and all of that stuff is forming. See that? All of this stuff is forming, and then what happens is with London open, bam, it will reverse. Okay, the whole thing will reverse like this. Okay, so keep in mind, most of the times there will be this false run in the opposite direction. Okay, now yeah, I did not make these things up. This is from ICT. Okay, this is what ICT calls the Judas swing. Okay,
Judah?
this is what Judas swing. Okay, yeah, he has some fancy names.
Okay,
Okay,
okay.
yeah, this is what he calls the Judas swing. Okay, the false run in the opposite direction. Okay, a false run in the opposite direction, inducing bias into the market. See, a fake trend line forming, more and more bias are getting induced. But what are they actually doing? Why are they doing this? Okay, firstly, to induce bias, and then they are reaching a key level of resistance. Okay, a key level of resistance. Now, when I say a resistance, not the YouTube support and resistance stuff, not that. Okay, something like a high probable bearish order block. That is what they're reaching now. Why is this high probable? Because we have Asian range liquidity being fed into that point of interest. See that? Asian sessions liquidity being fed into that point of interest. So price goes up. A false run in the opposite direction. Now I will show you examples of this thing. Don't worry. Okay, I'll show you examples. So a false run in the opposite direction. So with London Open, what happens? Bam. Everyone will get taken out. Okay, everyone will get taken out. So this is what happens. Okay, see now trend line traders, breakout traders, okay, maybe smart money traders too. Okay, smart money traders too who wanted to buy from these areas and all of that, even they will get taken out and then they will reverse this thing like this. Okay, this is what happens. So keep in mind, this is what we call the Judas swing. The Judas swing. Okay, a false run in the opposite direction. A false run in the opposite direction, or else we have a accumulation, manipulation, and then a distribution, the AMD. Okay, this is what ICT calls the AMD, accumulation, manipulation, distribution. So the manipulation usually occurs during London Open. Okay, during London Open. So this is what happens on a bearish day. Now, since we're from India, yes, now since you're from India and I'm from Sri Lanka, so we're in the same time zone. So we can trade London and New York both. Okay, we can trade London and New York both, but I'll tell you, trade London. Okay, London is the easiest to trade, and like all of the quick moves happen during London. Like if you get one trade like this, like you're done for the day, right?
Yes.
This is all you need. This is all you need. Okay, so I'll show you how to get that. This is all you need. You're taking a sell here, targeting the Asian low, and bam, like within minutes, like will like most of the time this will happen like in less than 1 hour. Like this is all you need, right? In 1 hour, your targets are hit and
Is
you're
it
out
known
of
as
the
an
market. Yeah.
ICT kill zone, right?
Yeah. Okay. Now the ICT kill zone start 1 hour before the session. Okay.
Okay, good to
The
know.
London kill zone. Yeah. 1 hour before the session. 1 hour before London session is the London kill zone. Okay. 1 hour before the New York session is the New York kill zone. Okay. So like yeah. Now basically the London kill zone is the Frankfurt session. Okay, it's the Frankfurt session, but yeah, we call it a kill zone because that is where like something like a lot of fake moves will happen, a fake breakout structure. They will give you all of that, and then with London Open, everyone will get taken out. I'll show you. Okay, because the sessions will always open with fake moves. Okay, the sessions will always open with fake moves. Okay, so I'll show you that. But you get this thing, right? I hope you understood it. Yeah.
Absolutely. Sure.
Okay. Sorry for that. So that's about that. And same thing on a bullish day. Okay, what they're going to do is they will give you a false run in the opposite direction like this. Why? First thing, session breakout traders will get induced. They will think, okay, now price is going to fall. Okay, and then a fake trend line forming and all of that liquidity getting built up. But what are they doing? A false run in the opposite direction. Okay, a false run in the opposite direction. Why are they doing that? Okay, why are they doing that? Building up more and more liquidity. Okay, sellers are getting induced, sellers are getting induced, but what they are actually doing is they are reaching a key level of support, something like a high probable point of interest. Okay, a high probable point of interest like this, so it drops back down, and then what happens with London Open? Bam, reverses. Okay, so this is what we call the Judas swing right here. Okay, the false run in the opposite direction. That is what we call the Judas swing. Like sellers will get induced into the market, this fake trend line is forming, everyone will be wanting to sell this thing with London kill zone, or else with London Open, bam, everyone will get stopped out. Okay, so there's the Judas swing. So it's always when now we can do two things. Okay, now I'll show you examples. Okay, we can do two things. What I would do is I will sell it from here to here and then buy it from here to here. Okay, like there are ways that you can trade the fake move and you can trade the right move too. Okay, but you have to do a lot of back testing. I'll show you. Okay, this is what I always do. I'll sell it and then I'll buy it. Okay, so we are like if you know their intentions, you can play along with them. Okay, so all of this stuff is possible not with London Open, but yeah, even with New York, it's the same thing. Okay, now London will open, and after 1 or 2 hours, it will go into the London lunch. Okay, the London lunch. So same thing. Once again, it might start building up some liquidity like this. With New York Open, they will do this. Bam. Okay, so same thing that happens here. Asia builds the context for London Open. London lunch builds the context for New York Open. They will do this and then bam. Okay, this is what's
So
gonna
all
happen.
of these things have been
Yeah,
told as
yeah,
something like the price time theory.
yeah. Even like time and price. Okay, time and
Exactly.
price will
This is
play
a
a
that is
major
the
role.
relation, right?
Yeah, now this is not actually it. Okay, now ICT is the one that knows the time and price thing properly, but this is all I know, honestly. Okay, I do not know anything about this, but I'll show you how time and price works. Okay, because with London Open, with London Keys on Open, a lot of fake moves will happen. Okay, so you can trade all of that too, even the fake moves, you can trade it, knowing that it's a fake move. Okay, so yeah, this is what happens with London Lunch. They will build up some liquidity, so price will drop back down with New York Open into that order block that was created during London. Okay,
Okay.
like this. And then yeah, when price comes here, you can look for a setup once again for what are we looking for? Simply a bullish QM, and then you can buy this like that. Okay, so this is what happens. This is what happens. Accumulation, manipulation, distribution. Accumulation, manipulation, distribution. Okay, that is how it goes. Can you understand it? Yeah.
So this happens every day,
Okay,
right?
not every single day. Okay, now yeah, it happens every day. Okay, now because I will show you examples, it actually happens every single day. Okay, it happens every single day, but the thing is, okay, but the thing is it doesn't happen very clearly. Okay, it does not happen that clearly, but it's the same stuff that keeps on happening every single day. Okay, it's the same stuff that happens in different ways. This same stuff will happen in different ways because just think of it. If they keep on doing this every single day, then everyone will figure this out, right? Then everyone will figure this out. Okay, so it does not happen that clearly, but yeah, it's the same logic behind every single thing. Okay, so this is about the Asian session thing. And yeah, Asian highs, Asian lows, and the Asian midline. Okay, so even the Asian midline will be very powerful. Because why? Now let's say price is in a consolidation. So to break out of this consolidation, now you have seen this, right? Like sudden breaks out of a consolidation. Okay, so to break out of the consolidation, the institutions are going to use the equilibrium level of the consolidation. Can you understand that? Okay, they're going to use the equilibrium price of this consolidation to break out of it. So if there is a point of interest lining up with the equilibrium level of a consolidation, it is going to be high probable. Okay, give me a second, I'm having a cough, give me a second. Okay. Okay, so if there is a point of interest, can you hear me? Yeah,
Yeah.
can you hear me, bro?
Yes. Yes.
Okay, so if there is a point of interest lining up with the equilibrium level of a consolidation, it is going to be high probable. Okay, now we're not going to expect direct moves like this. No, we're going to expect liquidity to get built up and then a move like this. Okay, liquidity is the main thing. So this is only for extra confluence. Okay, so same thing. Now, Asian session is also a consolidation, right? So to break out of Asia, most of the time they are going to use the equilibrium level of the Asian session, the midline, Asian midline. That is what we call it. So if there is an order block or some some point of interest lining up with the Asian midline, that also can be used for extra confluence. Okay, confluences of events. Can you understand that? Yeah.
Okay.
Okay, so see, even in this example, okay, where did price come into? Now there is a very high probable setup. See that? Where did price come into? Right into the midline. Okay, we have liquidity. Okay, we have the QM level, we have the Asian midline, all of that. Look at the move there. Bam. A very high probable setup. Okay, like you know the QM levels, right? The QMLs. Bam. This is where the QM is. And then liquidity got built up, tapped, and it goes. Okay, tapped and it goes. So this will be a very, very high probable setup. Asian midline is also here. Okay, so can you understand that? Yeah. Okay, that's about that. And then let's go into the high time frames once again. So now you know why we are not gonna trust this low to hold, right? We know why now you know a lot of liquidity is resting below that low. So you are not gonna expect that to hold. Okay, you're not gonna expect that to hold. So we can't take this as the liquidity and then wait for this to play out. Because look at this. How far away this is from this low. 30 pips away from the point of interest. So there will not be 30 pip manipulations, right? Who will do a 30 pip manipulation? Because if it now after taking this low out, if it keeps dropping for 30 pips, then the people that had their sell stops here will be in deep profits, right? Will be in deep profits. Okay, so that won't happen. They will quickly, after taking that low out, they'll quickly pull back up. Okay, they will quickly pull back up. So you have to look for a point of interest that is closer to this inducement. Okay, closer to the inducement. Now, actually, you don't even have to have a point of interest. If you know that this is liquidity, simply what you can do is as soon as it gets taken out, look for a bullish QM to form, buy it here. That's it. You can buy it here. Okay, so you don't even have to have a point of interest. But yeah, if you really want to, you can look for a point of interest. And if you pay close attention, you can see from the high of this wick to the low of this wick, there's a little imbalance left.
Yes.
See that? Now
Yes.
this is not an accident. Okay, this is nothing random. They did this on purpose. Okay, they did this on purpose because now they have a reason to come back down, right? Now they have a reason to come back down and fill the imbalance because there is a lot of liquidity resting below that low. Okay, so this is how I would personally refine it. I will refine it to this wick. That's it.
Okay.
Okay, my entry on the imbalance close price section, my stop loss below this, below this wick right here, or as the body of the candle that has the imbalance. Okay, this is how I would personally refine it. Can you understand that? Yeah. Yeah,
But
like this.
I have some doubts because we can take that wick also as a dimension, right?
Yeah, you can even take this wick. You can even take this week. Okay, yeah, you can even take the whole week. Okay, but for me personally, I will always look for the one that is, look for the point of interest that is closest to the inducement. So what's the closest one? It's the imbalance, right?
Yeah.
The imbalance is the one that is closest, not this week. Okay, not the week, the imbalance. Okay, so I'm going to use
So
the
you're saying
imbalance
that
there.
we should
Yeah.
look for some sort of imbalance and a POI.
No, it's
When
like
it's
this. You have to use the one that is closest. See that?
okay,
You can use the one that is closest to the inducement. So what's the yeah, what's the closest point of interest you have? It's the imbalance, right? Not the wick.
yeah,
Not the wick. It's the imbalance. So we can use that imbalance then. Okay.
okay.
And
So
then
we are using the 4 hour time frame for identifying these kinds of higher time frame structure, right? Or
now anything, any time frame. Okay. Now I'm just going to show you the example of this thing. Okay. I just wanted to show you an example only because price is fractal.
yes,
Okay, price is fractal, so the same thing happens on every single time frame. Okay, every single time frame. Okay, now this is not only applicable for lower time frames. Okay, so you
okay,
can do this. Stop loss here. Give me a second, like, sorry for that, I'm having a little cough today. Okay, see that? And we're targeting higher prices. Okay, give me a second.
okay.
Okay, can you hear me, bro?
Yeah,
Sorry for that, my voice is a bit off. Okay, so we're doing something like this now. When everyone else is wanting to buy from these areas like this, okay, with their stop losses all below this low, we're going to buy below that. See that? We're going to buy below that. Now, why would you want to go to a lower time frame? It's just 4.6 pips. See that? Why would you want to go to a lower time frame? Okay, because we use lower time frame only for refinements, right? Now, why would you want to refine this? This is a 4.6 pip stop loss. Okay, so then what happened? What happened? Right into the entry and then look at the rejection. Look at the rejection. Okay, this is that rejection you will get every single time you get the right entry. Okay, look at the rejection. Okay, like instant profits. As soon as it taps you in, you're in 40, yeah, 50 pip profits. Okay, and then where are we targeting? We're targeting this high itself.
okay,
Okay, we're targeting that high itself. And if you look into market structure now, what happened? Higher highs, higher lows, higher highs, higher lows, higher highs, and a fake breakout structure. See that?
yes,
A fake breakout structure right here. Now, what did they do? When they broke below that low, now everyone would have looked at this as a breakout structure, and now they will be wanting to sell from these areas, right? Expecting moves like this.
yes,
Can you understand it? Okay, because why? This was a breakout structure for them. Okay, so then what they would do is they will, yeah, they might look for points of interest from these areas, and they will be looking to sell this thing, right?
yes,
They will be looking to sell this thing from these areas. Okay, and look at what happened. Look at what happened. Okay, started going up. See, this is the reaction you will get. Okay, it will shoot up. It will shoot up, and when price gets into these areas, look at that. Okay, what happened? Look at the drop. Why are they doing that? Inducements. Inducements. See, even a breakout structure. Even a breakout structure. So imagine after this breakout structure, how many people would have wanted to sell it from these areas? See that? How many people would have wanted to sell it from these areas? A lot, right? A lot of people. Now, remember, in these types of candles, the volume is always in the body. Okay, so you don't have to mark out the whole thing like this. You can just mark out the body. Okay, so yeah, everyone will be willing to sell from these areas. But if you take a look into the bigger picture, okay, look at all of this liquidity getting built up, a fake resistance. See that? Every single time price comes into that level, what happens? It drops. It comes into that level, it drops. See that? So that's a retail resistance, right? That's a retail resistance. So we are not going to trust them. Okay, that should be our target. Okay, the retail resistance should be our target. Now look how risky sells from these areas are. Very risky, right? Very, very risky because a lot of liquidity is resting above that high. Okay, a lot of liquidity is resting above that high. Like even I took this sell here, no problem with that. Even I took this sell here, but I'm not gonna hold this into these areas. Okay, because keep in mind, the exits are more important than entries. Okay, like anyone can enter anywhere, but where are you going to pay yourself? That's the most important thing. Okay, now imagine if I took a sell here and did not take anything off until it gets here. What happens? I'm going to get stopped out, right? Because look at all of this liquidity. Okay, and since we are intraday traders, we could trade this thing because that's see that? That's an 80 pip move. Okay, that is an 80 pip move. So for an intraday trader, that's more than enough, right?
Yeah.
That's more than enough. Okay, so yeah, even I took it and I closed everything from this imbalance. That's it, because of all of this liquidity. Okay, because of all of that liquidity, and I closed everything, then price started retracing. Now imagine how many people would have wanted to sell it from these areas. And look at the reaction once again. Look at the reaction. Why? Liquidity. More and more liquidity is getting built up. Now people might have taken this as a QM. Stop hunt, breakout structure, and they will be wanting to sell from these areas. But then again, you have to always look into the liquidity. See this? A lot of liquidity is getting built up. So then again, I told you, right? If liquidity is getting built up, what are we going to do? Look for a point of interest above that, because that's going to be high probable, right? Liquid above an entry above the liquidity. I told you. So if you look at this, can you see this imbalance? See that? So why did they leave it there? Okay, nothing random. Nothing random. Now you might be looking at this imbalance too, but this imbalance was actually filled on most of the brokers. Okay, from broker to broker, the information differs. Okay, so always, yeah, trust the broker that you're using. Okay, trust the broker that you're using, like the one that you use to execute your trades on MT4. Okay, so let's say if it's IC market, see if IC market has filled it. Okay, but yeah, on most of the brokers, this thing right here was filled. So this was the one that was not filled. Okay, so if this is liquidity, this is going to be high probable, right? This is going to be high probable. And then what happened? Now imagine how many sellers are trapped here. Fake resistance, smart money traders, the ones that are trading market structure, everyone is trapped here, right? Everyone is trapped here. And then what happened? Straight through it. Okay, straight through it. Okay, now I honestly, I took this sell here, but I couldn't take the, I took this buy here, but I couldn't take the sell. Okay, I could not take the sell here. Okay, because yeah, I think I did not trade that day or something. But yeah, what happened? Tapped into the imbalance and now it's coming back down. See that? Just a little tap into the imbalance and it's coming back down. Now, why was that imbalance high probable? Because of all of that liquidity. Yeah, I'll have to refresh this every single time. We have every 10 minutes, because there's an issue with trading which is laggy. Okay, so yeah, price will go up. And look what happened to the smart money traders. Wanted to buy here, stopped out. Wanted to sell here, stopped out. See that? They have no idea what's going on. No idea what's going on. But if you look into the liquidity, you know what's going on. See that? And even the retail traders, see that? A broken resistance might turn into a support. So they will be expecting moves like this. See that? They'll be expecting moves like this. But what happened? What happened? Now they're falling back down. Look at that. Once you enter with liquidity, this is the reaction you get. 60 pips instantly. Instant 60 pips. Okay, this is the reaction you get every single time you enter with the liquidity. Look how hard it's falling. Okay, it will fall back down like crazy. Okay, so it dropped back down. And then, yeah, let's go to the 4 hour. Let's go to the 4 hour. And then look at this. This liquidity, okay, that is what shows you that a huge reversal is about to happen, right? Can you understand that? When there is liquidity like this, you can expect a huge reversal to happen all the time. Okay, all the time. So then now look at this. A reversal is about to happen, right? Look at all of this liquidity getting built up. A fake resistance. Okay, a fake resistance. And then what happened? Now they're falling. Now they're falling like crazy.
That was huge.
Look at that. Yeah, like if you took a sell there, you are still in profits. See that? If you took a sell there, yeah, that was like 600 pips, I guess. Yeah, almost 600 pips. Okay, so that's the thing. You understand the concept, right? Where is the liquidity? Entry below that. Where is the liquidity? Entry above that. Okay, always like dodge their traps. Like, see, even like how many times did they fool you? Look at this breakout structure. Look at that fake breakout structure when it taps here. How many sellers are induced here to get their confirmation entries? See that? How many traders are induced here? Okay, like if you go to a lower time frame, look at the reaction they gave. Okay, look at that reaction. when price tapped into these areas. Look at the reaction. Why? Inducements. Okay, inducements. See, like a 30 pip reaction, and then what happened? Straight through it, straight through it, tapped into this, and then it dropped. Okay, that's the thing. Okay, so you have to always pay attention to like all of the liquidity that is getting built up. Okay, that's the main thing. Okay, you have to pay attention to that. And yeah, that's it. A very simple trade, a very simple trade. Like, look how they fall all the time. It will come into your entry like super fast. Okay, but like, what have we been taught? Do not catch a falling knife, right? Do not catch a falling knife. So who would want to enter it here? Look at how it's dropping. A very quick move, and then a very quick move to the upside. See that? Okay, so you have to always pay attention to all of this stuff. Okay, because we're price action traders, right? We have to pay attention to everything that price action is showing you. Okay, everything. So that's the thing. It dropped back down very quickly, cleared out all of this liquidity. So we entered here, and then it started going up. Okay, very simple. Can you understand it? Yeah. Okay. So that's about
I
that.
have
Yeah.
some doubts. Can you please
Okay.
give me the access to the annotation tool?
Yeah, I think I have given you permission.
Yeah, yeah.
Yeah.
So can I mark?
Yeah, yeah, sure. You can do anything.
Um, See, one thing I always got confused about is this
Okay.
thing. You see this thing, this wick.
Okay.
The whole of this wick is an unmitigated zone, right?
Yeah, it's an unmitigated zone.
So what I will do is I will
Yeah.
wait for it to come down here and wait for a QM or kind of a
Into
chart
the
to form.
wick?
And yes, so
No.
that thing always get into a
Yeah,
confusion.
that's why I told you. The closest one. Okay, the closest one. What's your closest one? What's your closest point of interest? Now, when I
So
say a point
you
of
are you
interest,
are saying
yeah,
that here we have an imbalance. That's the reason
yeah,
you
that's the reason.
took this
That's
one.
the reason why I'm taking it exactly. Now, if there was no imbalance, if it was only this wick, for sure I'm going to use the wick. See that?
Okay,
For sure, I'm gonna use the wick. Okay,
okay,
but if there is nothing like that, now in this example, let's see that there was no imbalance, so we could have used the wick.
okay,
See that? We could have used the wick because why? The imbalance was up here. Okay, so then you could have used the wick. But yeah, in here the situation is different. We had a little imbalance right above the liquidity. See that? Right above the liquidity. So then you can use that. Okay.
okay.
So yeah, that's about that. And yeah, so is it clear? Let me know.
Yes. And
Yeah.
one more thing.
Okay.
Where is the dot? Yeah. Mhm. Okay. Here you took the body, candle body
Which one?
as the zone.
Yeah.
So why
Yeah.
did you took that as a zone?
Why didn't I
I mean,
use this as a zone?
why did you consider the body as a zone?
Now it's like this, okay? Now this is an order block, right? The last push up before the push down. Okay. So in these types of candles, in these doji types of candles, the volume of this candle is in the body, not the wick. Okay, not the wick. It is in the body of the candle right here. Okay, like if you go to a lower time frame, you might see that. Yeah. Okay, see that? Now, yeah, you can't actually see it on this time frame. Okay, yeah, maybe on this time frame. Okay, see the volume is always in the body. See, lining up with that level, there is another order block. So even in this candle, the volume is in the body. Okay, the volume is in the body, and you might even have a breaker block in this area. Yeah, see that? Okay, so the volume is always in the body. Okay, so keep that in mind. So you don't have to mark out that whole area. Like I'll show you another example. We are right here. Okay, look at this. You don't have to use the whole thing. You don't have to use the whole thing because why? The volume is always in the body. See that? The volume will be in the body in these types of order blocks. So you can mark this area out like this. So where will price come into? See that? Right into the body. Okay, that is where that is where the volume is. Okay, the wicks mean nothing. The body is where the volume is. Okay, so keep that in mind. Keep that in mind. You can always mark out the bodies of the candle when looking at order blocks. Okay, when looking for POIs, you can always mark the bodies of the candle. Okay, can you understand it? Yeah.
Yeah, sure.
Okay. So that's about that. So you understood this thing, right? A picture perfect example of this thing.
Yes.
See that? A picture perfect example. Fake trend lines, fake order blocks, fake reactions, but where did we enter? Right here. Right here is where we entered. Okay, so this is that. And then let's get into market structure and trading ranges. Okay, because identifying your proper trading range, your current trading range will be very important. Okay, identifying your current trading range, like constantly marking out your trading range, because every single time frame will have its own trading range. Okay, now the 4 hour trading range might be bullish. Okay,
Mm-hmm.
but the 15-minute trading range might be bearish.
Okay.
Okay, and the 5-minute trading range might be bullish once again. See that?
Yes.
And the 1-minute trading range might be bearish. Okay, so how are we going to use all of this? So if you identify the proper trading range, you can use all of it. Okay, you can use all of the trading ranges. So I'll show you how to use all of that. But before that, give me a second. I'll just have some water and come. Okay, give me a second.
Okay. Sure.
Okay. Can you hear me, bro? Yeah. No.
Yes.
Can you hear me? Yeah.
Yes.
Okay. So far everything is clear, right? Let me know, because until you get clear, I will teach this thing. Don't worry about that. Okay. So is everything clear so far? Yeah.
Yes. Yes. Sure.
Okay. Then let's get into market structure and trading ranges. Okay. Now, when we say market structure, now everyone will be like high highs and higher lows, right?
Yes.
But if the market moves this clearly, then everyone will be making money out of the market. Okay, so it does not move that clearly. Okay, it does not move that clearly, but let's use the same thing and I like understand why high highs and high lows are made. Like you always have to know the logic behind what's happening, right? You, that's the thing. If you know the logic, if you know the reasons behind why these things are happening, then you will know like where to enter and where not to enter. Okay, so that's the thing. So let's use this as the same example and see the reason why higher highs and higher lows are made. Okay, let's see the reason why it's made. Okay, so then let's see an uptrend. So let's say price is doing this, higher highs, higher lows, higher highs. Okay, so let's say we are in an uptrend like this. Okay, price is creating higher highs and higher lows. Okay, higher highs and higher lows. So remember, after every single break of structure, a new trading range will be created. Okay, so we have this break right here, and we have another break right here. Okay, this was actually a minor break. Let's delete that. And we have another break right here. Okay, we have another break right here. So let me move it here. Okay, so after every single break of structure, a new trading range will be created. Okay, a new trading range will be created after every single break of structure. So everything that I show you here is applicable on any time frame. Okay, it is not just limited to higher time frames. This is applicable on any time frame. So that's the thing. Like if you do not want to do this whole top down analysis and stuff, you can just play based off a lower time frame trading range. Okay, you don't have to spend hours and hours on a chart. Okay, you can just do a little analysis and play with the lower time frame trading range, but keep in mind it's always risky if you do not know the higher time frame trading range. It's always risky. Okay, but yeah, now let me show you this. So we had this low, from this low to this high, and from this low to this high. So your current trading range is from here to here. Okay, so what do you do when you get a new trading range? You have to look for discount and premium prices like this. Okay, because it's like a normal market. It's like a normal market. Now, if you want to buy a product, what would you do? You will wait for the price of that product to decrease, right? You're going to wait for the price of that product to decrease, or else until it gets into a cheaper price. So same thing here. Okay, same thing in this market. You have to wait until prices get cheaper. Okay, you have to wait until it drops into a cheaper price, or as a discounted price. Okay, now when I say a discounted price, it doesn't have to necessarily drop down into the 61.8 or into the 70.5 or into the 78.6. No Fibonacci retracements are required. If it just taps the equilibrium, that will be enough. Okay, so like no Fibonacci retracements are required. So a high probable bullish point of interest will always come from the equilibrium, or else anything below that. Okay, from the equilibrium or else anything below that. We're not going to look for any points of interest above the 50%, above the equilibrium. No. Okay, we're not going to look for anything out here. Now for sure they can move this, for sure that can happen. Okay, like they can do that for sure. Okay, because why? They do whatever they want to do. Okay, but we are not trading this, because why? It's not a high probable setup. Simple. Because it is not about trading every single move in the market, right? It's about trading the high probable setups, the setups where you can easily risk your money on. Okay, but these are very risky setups, right? Because what if they do something like this and quickly if it drops back down, you're taking a loss. You're taking a loss, right? So we have to always wait until it comes into the equilibrium, or else anything below that. Anything. Okay, so that's about that. So let's say we have the discount and premium prices marked and price is dropping back down. Okay. Now, what's the second reason they are dropping back down? It is to take out the internal range liquidity. Okay. The liquidity that is resting inside of this trading range. Okay. The liquidity that is resting inside of this trading range. Now, what is the liquidity? Now, first thing we can see on this same time frame itself, you can see swing lows forming, right? Like, do you know the three candle formation for a swing low and a swing high? Yeah, the three candle formation. No, let me show you. Okay, for it to be considered as a swing low, okay, for it to be considered as a swing low, it like always take three candles, choose three candles. Okay, now like this is all you need to see: a higher low to the left, a higher low to the right. The middle candle becomes your swing low. Okay, the middle candle becomes your swing low like this. Okay, all you have to see is a higher low to the left, a higher low to the right, and the middle candle is your swing low. Okay, the middle candle is your swing low. So that is all you need to see, a swing point. See, now look, because understanding this will be very powerful, because this is where the breakout traders are going to have their sell stop set. Okay, so look at this: swing low, swing low, swing low. All of these are swing points. So look at all of the liquidity in the market. In this little bit of price section, look at all of that liquidity. See that? All of these will be considered as swing lows. See? All of them. All of them are swing lows. See, even this. Why? Higher low to the left, higher low to the right, swing low. Higher low to the left, higher low to the right, swing low. Higher low to the right, higher low to the left, swing low. Okay, so this is where liquidity is getting built up. See that? Can you understand that? Yeah? All of that liquidity. Okay, so that is a swing low, and same thing for a swing high. Okay, it has to have a lower high to the left, lower high to the right. The highest candle becomes your swing high. Okay, that becomes your swing high. See, this is a swing high. So same thing, a lower high to the left, lower high to the right, swing high. Okay, that becomes your swing high. Even this little candle here. Why? A lower high to the left, lower high to the right, swing high. Okay, swing high. See, all of these are the areas that has buy stops above it. See that? Buy stops. Look at all of the liquidity in the market. That is why it moves this aggressively. Look at all of this liquidity. Now, yeah, now most people, when I say swing highs, okay, they will look for only the, like, yeah, only for areas like this. Now, when I say swing highs, most people will look for only these areas. No, those are not only the swing highs. Okay, the three candle formation is all you need. See that? This is all you need. Now, what happens? Every single time they run below a swing low, okay, look what they do. Goes below that, activates the sell stops, pushes back up. See that? Activate the sell stops, pulls back up. Even from this swing low, see? Activates the sell stops, pulls back up. Look at this. Every single time. Activate the sell stops, pulls back up. Okay, so this is what happens. This is what happens. Okay, so even here, activated the buy stops, pulled back down. And then once again, what happened? Activated the buy stops, pulled back down. Okay, so this is what they do. This is what they do. So the swing highs and swing lows are very, very, very important. Okay, in terms of market structure, in terms of liquidity, and all of that. The three candle formation. Okay, so yeah, you have to get used to looking at it that way if you were not already looking at it that way. Okay, so yeah, now inside of this time frame, inside of the same time frame, you can see these swing lows getting formed, right? The three candle formation inside of this trading range. So that is where the sell stops are. Okay, that is where the sell stops are. So when I say internal range liquidity, all of these swing lows that are resting inside of this trading range will turn into internal range liquidity. Okay, internal range liquidity. So the reason they are dropping back down. So keep in mind, a drop in a bullish market is a hunt for sell stops. Okay, a drop in a bullish market is a hunt for sell stops. So price comes back down, clears out the sell stops or as the internal range liquidity. After taking out the internal range liquidity, where will they go next? They will go after external range liquidity. Where is the external range liquidity? Right above this high. Okay, or else after taking out sell stops, where will they go next? They will go after buy stops. Where are the buy stops? Above that high, like that. Okay, so then you can see a high low and a high high. Okay, so can you understand that? Yeah, let me know. Is everything clear about this? Do you have any other doubts? Yeah,
See, I have one doubt.
yeah,
Can you? I will use the annotation tool.
okay.
Mm, can you see this?
Um, yeah, I'll see that only after like 5 seconds, I guess. No, I can't see it.
Uh,
Ah, yeah, 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 I can see it now.
okay.
Yeah, yeah, I can see it.
See, all these were the internal range liquidities, right?
Yeah, yeah, yeah.
Um, so the thing that confuses me about this thing is, um,
Okay. Sometimes price will go up without clearing the internal range
yeah,
liquidity.
yeah, yeah,
Is
yeah,
that
yeah.
the problem?
So
Yeah, I know that's your
how can
problem.
we identify that?
Okay, okay, I'll show you. I'll show you. Now have your drawing as it is. Don't delete it. Okay. Now I told you. Ah, you did it. Okay, it's okay. So let's say we had it this way. Okay. So I told you, right? Discount and premium prices
Yeah.
like this. Okay. Now this is the thing. Now let's assume this is the 4-hour trade in range. Let's assume this is the 4-hour trade in range.
Okay.
But inside of the 4-hour trade in range, you might have a daily point of interest like this. See that?
Okay.
Last push down before the push up. So this is a daily point of interest and it is in a discounted price. See that?
Okay.
It is in a discounted price. So then this internal range liquidity is being fed into this point of interest. So it's high probable, right? So price can do this. They can come back down to this and then go up like this without clearing this liquidity out. Why? Because there was a higher time frame point of interest here. Simple. See that? That is the reason why they don't come back down all the way into these areas all the time. Like sometimes they do, sometimes they do. Okay, but what if now? Most of the time they clear out all of that when there is a lot of liquidity, like trend lines like this forming, then they will clear out all of this and then tap into this. Because we can't look for any POIs from these areas, right? Why? A lot of liquidity, a lot of liquidity. So then, yeah, so then they can clear this out. But sometimes they can go from here without clearing out these lows because why? this is a higher time frame point of interest inside of this lower time frame trading range. So they can tap here, clear this internal range liquidity into this point of interest, and then go up. See that? That can happen. That can happen. Okay, so that's the reason why I asked you to look for discount and premium prices. Okay, so is it clear? Is it clear? Yeah, I know your question before you ask it, because everyone asked that. Okay, so yeah. So yeah, then price can drop back down to clear out the internal range liquidity. So after clearing out the internal range liquidity, where can we expect price to go next? External range liquidity, right? Yeah, like this. After taking out sell stops, they will go after buy stops. So took these sell stops out, then you can expect the buy stops to get taken out. Simple. Okay, now, but how do we confirm that a new trading range is created? Okay, how do we confirm that a new trading range is created? Now, this is the most important thing about trading ranges. Okay, keep this in mind. This is the most important thing. So let's say we had a strong low created. So internal range liquidity is taken out. And after that, where will price go next? External range liquidity. Okay, so now let me mark out the swing lows too. So let's say price is going up like this. Let's say price is going up like this. And only once you get a break outside of this trading range, okay, only once you get a break outside of that, you can consider this as your strong low, or as the low of the new trading range. Okay, the low of the new trading range. But how are you gonna mark out your high? So you can't take your high from here to here. No, you can't do that. Okay, there's a way to confirm the high. So for you to confirm the high, it has to give you a break of structure in the opposite direction. See that? Only once you get that break of structure, this becomes your new trading range. So see, higher highs, higher lows, higher highs. Okay? Only this break of structure. This is the most important thing, the break of structure in the opposite direction. Now, when I say a break of structure, I mean a swing low. You saw the swing low, right? A swing low getting broken. That's it. The three candle formation getting broken. That is all I want to see. Okay, after breaking out of this high, I want to see a swing low getting broken. That's it. Now, when I say a break of structure, now there are many ways of looking at break of structures, right? Some people might look at it as a wick to wick break, or as a body to body break. Okay, but for me, the high probable break of structure is a wick to body break. Can you understand it? Something like this. Like, yeah, let's take it this way. This wick has to be broken by a body closing, like that. Can you understand that?
Yeah.
The wick has to be broken by a body closing. That those are the most high probable breaks of structures for me personally. Okay. Now, yeah, there are times I don't use it that way, but those are the high probable breaks. Okay, those are the high probable breaks. The wick has to get closed, has to get broken by a body closing above it. Yeah.
Okay.
Okay. Like, yeah, sometimes you can use like maybe a wick to wick break too. Okay, maybe a wick to wick break too, but yeah, it depends. It depends on the situation. Okay, but yeah, with enough back testing, you will know what to use. Okay, something that is high probable for you. Okay,
Okay.
that is personal preference actually. You can see like some people use body to body, some people use wick to wick, some people use body to wick or is wick to body, like all of that stuff. Okay, but yeah, for me, this is what I'm gonna use. And yeah, okay, this is what you want to see. Like simply, okay, in simple words, you want to see a bullish QM and then a bearish QM. That's it. That is what confirms your trading range.
So,
That's it.
if you're viewing this
Yeah.
structure in a 4-hour time frame, so
Okay.
to consider it as a strong high, um,
Weak high. Yeah, that
strong
is a
weak
weak high.
high,
Okay. A
we need
strong
to
low
go
will always
for,
create a weak high.
okay,
Yeah.
we need to go for the lower time frame, like 1 hour,
Yeah. Now it's
to,
better. Now, yeah, even the 1 hour is okay, but it's always high probable if you get a swing low broken on that same time frame. Now you know about the swing lows, right? Yeah, the 4 hour time frames swing low getting broken.
okay,
Then
what I
it
mean
is
is,
even more
sometimes we
high
can't
probable.
see any swing in the 4-hour time frame. So,
Yeah,
at
sometimes you
that,
can't. So then you can use a 1 hour at least.
okay, okay.
Okay. Then you can use a 1 hour at least. Now, let me show you a nice example. So let's say we were right here.
Mhm.
Let's say we were right here. Now look at this little bit of price action. Okay, now if you look at market structure this way, this is going to be very, very high probable. What's this? A stop hunt.
Okay.
A stop hunt and a break of structure, right? A break of structure. Stop hunt, break of structure. If it gives you a stop hunt and a break of structure, this becomes a strong low, right?
Mm-hmm.
This becomes a strong low. How do we know this strong low has created a weak high? I told you, you have to get a break of an intermediate term swing low. Look at this, three candle formation, three candle formation, and a three candle formation. So now they have created a higher high, and here we have the break.
Okay.
See that? So here is our trading range from here to here. Okay, a bullish QM is here, and a bearish QM is here. See that? A bearish QM is here. So why is price dropping back down into a discounted price? What's the other reason? To take out the internal range liquidity. What's the internal range liquidity? The swing lows that is resting inside of the trading range, right? That is the internal range liquidity. So what happened? Came back down, cleared the internal range liquidity. So when price clears that out, where are we expecting price to go next? External range. See that?
Yeah.
Yeah, external range. What happened? Right into the targets.
Okay.
See that? That's how we take a range high and a range low, like this. Okay, this becomes your trading range. Can you understand that?
Yeah.
This break, yeah, this break is the most high probable break, because now as soon as price goes above this, if you go to something like a 5 minute, for sure you can see breaks here. You can see that. For sure you can see breaks here. But what was your current trading range when price was right here? When price was right here, your current trading range was from here to here, right?
Yes.
Can you understand that?
Yeah.
On a lower time
On a
frame,
lower time.
your trading range, yeah, is from here to here. So what if they decide to respect that and go back up? So if you take a sell here, you will get stopped out, right?
Yes.
That's the thing. That's why I told you on the same time frame. Only once you get this, you can confirm the trading range. Okay? Is it clear now?
Yeah. Yes.
Okay, so let me delete this. So yeah, something like this is what you want to see. A swing low getting broken. Okay, a swing low getting broken. That is what confirms the trading range. Now let's say like this cannot be taken as a break of structure. Why? Never created a higher high.
Then
Never
it
created a
should be
higher
on a
high.
lower time frame.
Okay.
Yeah.
Yeah, might be an inducement on a lower time frame. You can buy it from here.
Yeah.
Okay, no problem with that. Like this. Like because what's a QM? A QM is something like this. A bearish QM is a higher highs, higher lows, higher highs, and a lower low, right?
Yeah. Yes.
That is a bearish QM. So this is not a higher high, right? This is a lower high. It has to create a higher high and then break.
Okay.
Then this is your trading range. Okay,
Okay.
it makes sense, right? I
Yeah.
hope it's clear. Yeah. Now, look, the thing is now the most common mistake people do is they will take this as the low, and as soon as price breaks out of this high, they will take this as the low, high of the trading range and draw their discount and premium from here,
Yeah.
and then expect that then price will do something like this and it will go like this.
Even I
Then they
was
will be
also.
like, oh, this went from a, yeah.
Yeah. Even I was also doing like this only.
Yeah, that's the thing. Then you will not get the proper discount and premium prices. Then everyone will be like, oh, it went from a premium price. But no, it did not. It went from a discounted price of this trading range. See that? Price is fractal. Price is fractal. So what you can do is until the higher time frame external range liquidity is taken out, buy it from these areas. You can stack up entries using the lower time frame trading ranges. See, you had a break here. From here to here is the trading range. You could have bought it here. Then you had a break here. From here to here is the trading range. You could have bought it here. See that? So you had a break here. I told you after every single break of structure, a new trading range is made. So you had a break here. From here to here is the trading range. You could have bought it here.
Yeah.
You had a break here, here to here, bought it here, bought it here. See that?
Yeah.
That's the thing. Okay, you could just stack up entries using the lower time frame trading ranges. Okay, so is it clear? Yeah.
Yeah. It should.
Okay. Then let's say something like this is happening. Let's say price is moving back up and you had a bearish QM formed here before a new higher high is made. Okay, now this is when things get interesting. Okay, now what is your current trade in range? Okay, that's the thing. If you know your proper trade in range, okay, that is what's gonna give you the proper bias. Okay, now what is your major breakout structure? It's here, right? And that breakout structure is still bullish. So this little breakout structure cannot say that GU is gonna be bearish. No, because your higher time frame breakout structure is still a bullish one. Okay, it's still a bullish one. So look at this. The higher low is supposed to create a higher high, right? The higher low is supposed to create a higher high. So if this is the higher low, it has to create a higher high, right? It has to create a higher high. But what happened? Failed. Okay, this breakout structure is the indication that this low has failed to create a higher high. The low has failed. It's a failure swing. So our current trading is still from here to here. Okay, from here to here, not from here to here or from here to here. It is from here to here. See that? So this low has failed to create a higher high. So if it fails to create a higher high, this becomes a weak low.
Okay.
See that?
Yeah.
Then it becomes a weak low. Now you cannot expect confirmation entries from these areas. Why? It is a weak low. It is a weak low. So you can't buy from a weak low. You're going to take this as the liquidity or as the inducement now, and you're going to look for something below that. See that? This is the reason why people get stopped out. They will look for confirmation entries from these areas like this, and then price will stop you out on the confirmation entry itself.
Oh.
Price will do this. See that? You would have seen this happen. Okay, so that's the
Many
reason.
times.
That's the reason. Okay, so basically you're trying to buy from a weak high. So you'll get stopped out. No wonder why you're getting stopped out. Okay, now if it's a weak, I'm sorry, it's a weak low, not a weak high. Okay, yeah. So if it's a weak low, it's obviously getting taken out, right? It's weak. It's weak. Okay, now why is this liquidity once again? Not only because it failed to create a higher high. Okay, if you look at this, it's a trend line. Okay, it's a trend line. And this might be, yeah, let's mark that out as liquidity, and this might be a broken resistance turning into support.
Okay.
See that?
So
This
range
might
might be
even
there is
be,
in our liquidity.
yeah, this is internal. Okay, internal, still inside of this trading range. Okay, yeah, same thing. And see, from here to here, this might even be a Fibonacci retracement, like the 78.6. You know how famous these levels are, right? Golden ratio, 61.8. So everyone will be buying from these areas. And you know the classic smart money setup, right? A stop hunt, breakout structure, RTO, the return to origin.
Yes.
You know that setup, right?
Yeah, yeah.
Stop hunt, breakout structure, RTO. So this might even be that. See this? A stop hunt, breakout structure, RTO. People might think this is their return to origin, and then everyone will start chasing this move because no one wants to like miss out on a good move, right? Everyone will start chasing it. Okay, and see all of this liquidity getting built up. Okay, but we are gonna look for something below that. We're gonna look for something below that, like this. Okay, then they can do something like this because they know that everyone will be looking to buy from here, but it's weak. It's weak. Okay, so price can come back down, sweep all of this liquidity now into this point of interest. Okay, now what is your current trading range? It's from here to here, right? So where are we currently at? We are in an extremely discounted price, right? Extremely discounted price. Look at that retracement, like a 90% retracement almost. Okay, so that's an extremely discounted price. Okay, extremely discounted price. So when price comes into extreme levels, what happens? They do not want the retail traders to enter here because that is a very nice pricing, a VIP pricing for the institutions. Okay, because this low is protected too, right? A stop hunt and a breakout structure. So that's a strong low. It's protected. So look how far, look how close they came to that protected low. So they do not want to spend a lot of time here. So once they get here, that's a VIP pricing for them. They will quickly move out of the trading range. These moves will be very quick, like this. Okay, so then you have a breakout structure. This becomes your low, and this becomes your high. See that? So this is the new trading range. Can you understand that? Okay, so everything that happened here is, what's that? Internal structure. Do not get confused by this internal structure. Okay, so these are your proper swing points here to here and here to here. So same stuff. What are you going to do? Okay, look for discount and premium, wait for price to get into a discount, and wait for all of the drama to end by below that. That's it. Okay, and make sure you have a look for the inducements too. Okay, the inducements too. So can you understand this? Yeah, let me know.
Yeah.
I hope it's clear. Okay, so this is a bullish market, and then same thing in a bearish market. Now let's go to a bearish market. Okay, now price is in a downtrend. Okay, now the price is in a downtrend. So what are we going to do? After every single break of structure, a new trading range will be created. So what is your current trading range from here to here? Okay, so like a normal market, what would you do? If you want to sell a product, you're going to wait for the price of that product to increase, right? Do you know that? You're going to wait for the price of that product to increase. So same thing here. You're going to wait until it goes into a premium price now. Okay, until it goes into a premium price, because it's like a normal market. Okay, into an expensive price. So that is anything above the equilibrium level. Okay, anything above the equilibrium level. Now it doesn't have to go into the 61.8 or 70.6 or 88.6 or nothing like that. If it just taps the equilibrium, that is enough. Okay, that is enough. So keep in mind, a high probable bearish point of interest will always come from the equilibrium or else anything above that. Okay, from the equilibrium or else anything above that. Okay, so we are not going to look for anything in a discounted price to sell from. Like for sure they can do this, but it will not last long. Okay, so you can take your intraday trades from these areas, no problem with that, but you can't hold it to these lows because you cannot swing a sell from a premium, from a discounted price. Okay, it has to always come from a premium price. Okay, so yeah, keep that in mind. And yeah, discount and premium and all of that stuff. So price can go up like this. Now,
But
what's the
most of
other
the time,
reason?
but most of the times when I see in lower time frames and also in
Okay.
higher time frames, most of the time price will not coming to those premium levels.
Okay, maybe you haven't marked it right because I'll show you. Because it always comes at least into the equilibrium. Okay, at least into the equilibrium it will come. Okay, so I'll show you. I'll show you. Yeah, sometimes they can always do what they ever want to do. Okay, whatever they want to do, they will do it. Okay, but yeah, most of the time it will come into discount and premium prices. Okay, like 90% of the time it will. Okay, so I will show you examples. Don't worry. Okay, but yeah, first I'll explain this and then I will show you the examples because after this, let's get straight into charts. Okay, yeah, then it goes into a premium price. And what's the other reason they're going back up is to take out the swing highs, the internal range liquidity inside of this trading range. See that? So a bounce in a bearish market is a hunt for buy stops. Okay, so they go up, clears out the buy stops or as the internal range liquidity. And where will they go next? External range liquidity.
Yes.
Okay, from internal range to external range, or from the after taking out the buy stops, they will go after sell stops. Okay, they will go after sell stops. So that is what happens. That is what happens. Now, how do we confirm the new trade in range? Okay, so price has to do this. Okay, so let's say we had a strong high created, so price has to come back down, and once you get a break below this low right here, that is what confirms the high of the trade in range. Because why? We have a bullish QM. Okay, but how do we confirm the low? You have to get a bearish Quasimodo. I'm sorry, we have a bullish, a bearish Quasimodo here. Yeah, now you have to get a bullish Quasimodo for you to confirm the low, like this. See that?
Yeah.
Then this becomes your new trading range, discount and premium. Okay, once again discount and premium, and wait for it to clear out the internal range liquidity. And now since price is fractal, you can do something like this too. Now let's say price is falling back down. Let's say you had a QM here. What are you going to wait for? On a lower time frame, you can use this as the trading range, discount and premium. Wait for the drama to end, buy below the inducement, somewhere around here. Where are you holding it into? Into the internal range
Into the higher
liquidity.
time frame.
Yeah, exactly. Exactly. Okay, the equilibrium is your safest target, right? Because they can just tap the equilibrium and then melt. That can happen. So keep in mind the equilibrium level is always your target. Okay, that is always your target, or else you can just hold it into this internal range liquidity. So let's say price is going up. So you can do this ping pong stuff. And after clearing out the internal range liquidity, when this counter trend gets broken, okay, a bearish QM is formed. Wait for this, sell above that, and yeah, it will drop. See that?
Okay.
So then you can do this ping pong stuff up and down if you know the proper trading range. And remember, price is fractal. Okay, price is fractal. So you can sell it from here to here. You can buy it from here to here. Okay, once again, you can buy it from here to here. You can sell it from here to here. All of that stuff is possible. Okay, only thing you have to do is mark out the proper trading range. Okay, so I'll show you. I'll show you how to do that. So can you understand this? Yeah.
Yeah.
Mm, okay. Let me refresh this. Yeah, I think because I have the $5 trading view premium thing, it's the free trial. That's why it's laggy. Okay.
Okay.
So now let's see what's happening. Okay, let's say price is coming back down like this. Let's say we had a bullish QM formed before a new lower low is created. Okay, so what's your trading range now? Now you can't use from here to here as the trading range. No, because why? It's weak now, right? It is weak. It is weak. Like for sure, you might get reactions. Okay, because why? We have liquidity being fed into that point of interest. So you might get reactions, but it's not gonna hold, it's not gonna last long. Okay, it is not going to last long because why? It's weak, right? It is weak. Now let's if this is a 4 hour time frame, for sure you can take intraday trades from here. Okay, for sure you can take intraday trades, but keep in mind you can't swing them because you're trying to sell from a weak high. Okay, why is it weak? It never created a lower low. It broke. It failed to create a lower low. This is the indication that it has failed to create a lower low. Can you understand that? Okay, so if it fails, this will turn into a weak high. Okay, this will turn into a weak high. So obviously, if it's a weak high, it is liquidity. It's getting taken out. Now, why is it liquidity? Not only because it failed to create a lower low. Okay, these trend lines, okay, support turning into resistance, Fibonacci levels, okay, or is this top hunt breakout structure RTO? Everyone will be selling this, but we're gonna wait for this, okay, something like that. All of that liquidity, these trend lines forming, all of that. Look at how much of liquidity. Okay, a lot of liquidity is getting built up. So what we are gonna do is we're gonna look for something above that. Okay, we're not gonna look for confirmation entries from here. Look for a point of interest above that because it is feeding liquidity into this. Then price can come up, sweep this liquidity, and when price comes here, it's a VIP pricing for them, like I told you. Okay, because that's an extremely premium price, right?
Yes.
Extremely premium price of this trading range. So when they come here, they do not want the retail traders to enter the market with them. So these moves will be very quick. They will quickly move out of the trading range like that. Okay, so once you get this break, okay, so you have a new trading range from here to here now. Okay, so same stuff, discount and premium, wait for it to end. You can even hedge it until it goes there. Okay, or else you can wait until it gets here and then sell it. Okay, so this is pretty much what happens with market structure. Okay, do not get confused with them because this is internal structure. Like price can spend like days and weeks inside of a trading range like this. Inside of this trading range, they can spend like, yeah, even a month inside of this trading range. But once it gets into the extremes, it drops. Okay, this is what happens. So you have to know your proper trading range. Can you understand that? Yeah.
Yeah, I got it.
Okay. Then let's get into the charts. Now, what the fuck is? Oh, okay. I have I have internet. Okay. Now, once we no no not once we now as a smart money trader, okay, as an intraday trader, what's the highest time frame that you would look at? Like personally, what's the highest time frame you would look at?
Uh, Firstly, I will go to the 4 hour chart and mark the
Okay.
strong highs and weak lows and those
Oh,
kinds of stuffs. And I will go
okay.
to that's my maximum highest time frame.
That's the highest time frame.
Yeah.
Okay, but that's okay for intraday trades. That's gonna be fine. Okay, but you have to always start with the higher time frames. Now, when I say higher time frames, at least the weekly. Okay, at least the weekly or the daily. Now, for me personally, I will always start from the weekly time frame. Okay, I will always start from the weekly time frame. Why? Why would I do that? Because like now when I say the weekly, I don't care about all of this. I don't care if the weekly is creating lower highs or lower lows. I don't care because I'm not a swing trader, right? I don't want a projection for the next couple of years or anything. Like price might never get into these areas. Who knows? Who knows? Okay, might never get there. All I want to see is the current price action on the weekly. Okay, like I'm not even gonna zoom out like this. Okay, no, this is all I want to see. This is all I want to see. Now, let me show you very clear examples. Okay, let me show you how to use all of the concepts that I taught you right now. So let's say we were here. Okay, now let's say we were here. First thing, what do I want to see on the weekly time frame? I want to see what my major bias is. So on the weekly, my major breakout structure is still a bearish one, right? See that? It is still a a bearish break of structure. So which means the weekly is still bearish, right? Simple. The weekly is still bearish because the major break of structure was a bearish one. And then what do I want to see? Where are we currently at? We are inside of a weekly supply or is a weekly order block. See that? We are inside of that. So what can I expect the next week? We can expect sells until at least this imbalance get filled. See that? This is all I want to see because if you get a bias for one single weekly candle, just one candle, you have a bias for the whole week. See that? You have a bias for the whole week. Okay, so next week we can expect until, yeah, we can expect a sell at least until this imbalance get filled, right? Because it's coming from a higher time frame point of interest. Now, this is all I want to see. This is all I want to see. Okay, this is all I want to see on the weekly. Then go to a daily. Then I go to the daily, and on the daily, what am I going to do? I'm going to mark out my trade-in range. Okay, the trade-in range on the daily. I'm going to mark out the trade-in range on the daily. Now, yeah, I'll delete this for a while, but keep in mind that this was a weekly point of interest. Okay, a weekly point of interest. Now, on the daily, what am I going to do? I'm going to mark out my strong high. So here it is. It is a strong high. Why? Took out all of this liquidity,
Okay, this is a
and
bearish QM, right?
yeah, that's a bearish QM. See this? A bearish QM. Okay, a bearish QM. So price has taken out all of that liquidity, and it has, yeah, a minor structure was broken here. Right here was where the minor structure got broken, and here we have the major structure broken. See that? The major structure was broken here. So this is a bearish QM, right? A strong high, never tested yet. Mark that out. Now, how do we know the strong high has created a weak low? What do we want to see? A bullish QM, right? A bullish QM. So here we have that.
Yes.
So here we have the break right here. Right here is where we got the break. Now, this is not a breakout structure. Okay, why? Because did this create a lower low? No, right?
No.
Never created a lower low. Okay, so that cannot be taken as the break. This is where price broke structure. So we can use this as the high and this as the low. Okay, is it clear? Is it clear? Okay, because yeah, the chart work must be clear. Okay, so I'll try to make it as simple as possible. So this is my trading range from here to here. Okay, so this we have this break, and if we look for discount and premium prices, where are we currently at? Premium price, right? Inside of a premium price, and we are inside of a daily point of interest, inside of a daily strong high. See that? Inside of a daily strong high, inside of a premium price, inside of a weekly bearish order block, which means it has a huge potential to the downside, right? We can expect sales now. Okay, we can expect sales this week. Okay, we can expect sales this week. Then I'll go to the 4 hour. I have all of this marked. Yeah, so let me mark this out properly. Okay. We have a strong high here. Another one here. Okay, like this. All right, so we have all of this areas marked. Now what do I want to see on the daily? Okay, what am I gonna do on the daily? Yeah, this is the 4 hour. What am I gonna do on the 4 hour? Yeah, what's that?
This is the 4 hour chart.
Yeah, this is the 4 hour. Okay,
Okay.
so on the 4 hour, what I'm gonna do is I'm gonna mark out my obstacles. Okay, now what do I mean by obstacles? Okay, you know what obstacles are, right? Like the things that are like blocking the way. Okay, now if I'm taking a cell here, it will not directly fall here. It will obviously pull back up. It will pull back up. Okay, so I'm going to mark out the zones where I can expect pullbacks from. Now, where will the pullbacks come from? From unmitigated strong lows. See that? From the unmitigated strong lows, that is where the pullbacks will come from. Okay, that is where the pullbacks will come from. So first of all, let me talk about this low right here. Now, this was a strong high, right? Why was it strong? It took out liquidity and it has broken structure. See that? So that is a strong high, a bearish QM. See that? That's a bearish QM. So then what happened? Look how hard they tried to break above that the bearish QM. Now, this is my point of interest, okay? Because see, these were the consecutive up candles that took out this liquidity. This did nothing. These were the candles. See that? Okay, so your focus must go into the candles that took out the liquidity. Okay, because if it's an order block, it has to make sense, right? It has to make sense. So this is the order block I'm looking at. This is the point of interest. See how hard they tried. Okay, they like for days and days they were trying hard to break out of that. Yeah, see, took them 10 days to break above that strong high, but eventually they broke out of that, right? They broke out of the strong high. So to break out of this strong high, where did the low originate from? It's here, right? So if this low broke above this high, this is a strong low, right? That's a strong low. And it has never been tested yet. Okay, never been tested yet. So mark that order block out. None of these, I'm not looking at this, I'm looking at this, the last push down before the push up. Mark that out. Okay, so we have one area marked out. Okay, and then let's see another area. So we have a strong low here, right? We have a strong low here. Why? Took out liquidity. Okay, it has taken out liquidity and it has broken structure. And now what do we want to see? Now this is a what's that? A bullish QM, right? That's a bullish QM. So what do we want to see? From the time that the bullish QM is created, we want to see a bearish QM, right? That is what we want to see. That is what we want to see. Like, yeah. Now look at this. All of the lows were protected, swing lows, swing lows, swing lows, until here it was broken. Now, if you use a line chart, you can see it properly. See that? Ignore the wicks. Ignore the wicks. See that? Can you see that? Here we have a bearish QM, a very clear bearish QM. See that? A very, very clear bearish QM. Okay, so which means this is a strong low, right? This is a strong low and it has not been tested yet. It has not been tested yet. So this area, we can expect a pullback. Okay, we can expect a pullback from this area. Okay, so now where can we expect the pullback from? Now, I don't care about this order block. What is the candle that took this liquidity out? What's the candle? It's this, right? See that? This was the candle that took the liquidity out. So mark that out.
Candle got
See that?
mitigated, right?
I'm sorry?
But that candle got mitigated.
This thing right here, not yet. Okay, this cannot be counted as a proper mitigation. It has to, like, after creating, now this is what we want to see. This is the strong low, right? Now don't look at the candle, don't look at the do not look at the candle. Is this bullish QM mitigated? No, right?
No, no, no.
Is this bullish QM mitigated? That's what you want to see.
We are looking it as
Is
a
it
whole,
mitigated?
right?
I'm sorry?
We are looking it as a whole. The Quasimodo is
Yeah,
looking
as
as
a
a whole.
whole. Exactly.
Okay.
We're going to look at that whole thing as a whole. You know,
There's no
we're
confusion
not going to
about
look
the
at this.
candle.
Okay. Yeah, we're not going to look at focus on this candle. We're going to look at the whole Quasimodo.
Okay.
Okay.
Right.
We're going to look at the whole Quasimodo. We're going to focus on the strong low. Okay. The strong low that has not been tested yet. But why is that strong low? Yeah. What is the most significant part of that strong low? It's this candle, right? The candle that took out the liquidity. So that is the reason why we are looking at that. Okay. So we have that. And one more area we have, and it is already testing that. See this? Stop hunt and a break of structure. Okay, so this could be used as an inducement into this area. See, this was the doji that took the liquidity out. Okay, so yeah, I think it tapped into that, never came into the body though. Yeah, it came very close. But yeah, now look at this. Can you use this order block? No. Why? Did it take out liquidity? No. Did it take out any liquidity? No. On this time frame, did it take out any swing low? Not, no, nothing. But it only broke structure. So what did I tell you about a strong low? It has to do a manipulation and then break structure, right? But yeah, this did break structure, but did it take out liquidity? No. So is it high probable? No. That's it. Okay. So yeah, so we have all of these areas marked. Okay, we have all of these areas marked. Now, when price gets here, what do you want to see? A QM. When price gets here, what do you want to see? A QM. Okay, so if the QMs are is now, yeah, I'm referring to it as a QM, so that's easy for you, right? It's simple, I guess. Okay, so yeah, now when price gets here, if you do not see this, okay, simple, you're not going to take the trade. You're not going to take the trade. Okay, you're going to, like, it will just go. All you have to do is just delete the zone. Like, that's not going to lose money, right? You're not going to lose money with that.
Yeah.
Okay, and yeah, when price gets here, once again, what do you want to see? That's it. If you do not get that, it will just keep on going. So you're not going to lose money. Okay, so simple. Simple. So you can have these areas marked. Have these areas marked out. Okay, we got them marked out. And then now let's go to a lower time frame. So we have everything marked, range marked, obstacles marked. Even this obstacle, yeah, currently the obstacle is getting played out. Now let's go to a lower time frame. Let's see how we could stack up the entries. Okay, let's see how we could get some trades. Okay, first thing I'll show you about how the trading ranges are playing out. Okay, we have all of this stuff. Yeah, like even this buy, where did it come from? Okay, I hope you saw that. If you mark out the Asian range, like, yeah, I got this buy, that's why I remember this. Asia starts at 2:30, ends at 9:30 IST. Okay, that's Indian Standard Time. This is the Asian range. Okay, where did this move come into? Right into the midline.
Okay.
See that? Right into the midline, and look at the move. Bam, shoots up. So I got my entry from this wick right here. See that? Where did it come
In
into?
this
A
case,
sniper
why
entry,
you
right?
took that wick
A
as a
sniper
target
entry, and it
POI?
goes. See that? Can you understand that about the Asian midline? Okay, very powerful. We had liquidity resting right above that, swept that liquidity, and it shoots up.
Okay.
Okay, and it shoots
I
up.
have one doubt. Why did you took this
Okay,
wick as a POI in this case?
in this week,
This
okay, I
week.
think, yeah, now on FXCM, okay, on FXCM, like, it was very clear. Okay, it was very clear. The midline was lining up right in this area. Okay, right in this area, and you can see that, right? The imbalance was above the 50%. The wick was where the 50% was. See that? So I'm not going to use this. I'm going to use the one that is below that. Simple. Can you understand that? Okay, Asian midline. So the if it taps into the Asian midline, like, if I'm entering off the imbalance, I'll get stopped out, right? Can you see that? If it wants to tap into the imbalance, I'll get stopped out because the midline was right here. See that? Can you understand that? I hope it's clear. Okay, so this is where the, like, you could have even used this whole area, but I refined it to the wick right here. Can you understand that? Yeah.
Yeah.
Okay, because if it wants to tap into the midline, if you entered off the imbalance, you're getting stopped out. Okay, so it's always better to use it this way there. Okay, see now, see how things are different, right? In that previous example, somewhere around here, I told you we're going to use the imbalance. Okay, we're going to use the imbalance. Okay, but yeah, in here, why are we using this? Oh shit, I have to refresh this. Why are we using this? Because the Asian midline was right below that. Okay, so there are chances of us getting stopped out if we use that thing. Can you understand that? Okay, I hope it's clear. Yeah. Okay, so then what happened? Now we are inside of the daily point of interest. What did price do? Took out liquidity, broke structure. We have a QM, right? Inside of the daily point of interest. Okay, so we can mark out that strong high. Let's use some different color, maybe. Yeah. Okay, we can mark out that strong high. Now, how do we know this strong high has created a weak low? First thing, it has to break below this. Okay, done. And then you have to get a break of a swing high, right? You have to get a break of a swing high. So not this, this. Can you see that? Like, if you use the line chart,
Okay.
here we have the QM. Yeah, here we have the QM. Not this. Not this, it's this.
Yeah.
See that? The QM. Okay, so we have a break of a swing high right here. So your trading range is from here to here. Okay, so now you know what to do. Now you know what to do. Discount and premium. Okay, let's mark out the trading range first, like this. Okay, now look at all of this. All of these were tradable too. Okay, because why? We had this top hunt. We had this breakout structure. Okay, then what's the high? This becomes your trading range, right? This becomes your strong high. Now I'm talking about this intermediate term structure. Okay, I'm talking about the intermediate term structure. How do we know this strong high? Now this is a bearish QM. How do we know this strong high has created a weak low? Here we have the break. See that? Created a low below and we broke. So this becomes your trading range from this bearish QM to the bullish QM, like this. Why is price going up? Take out the internal range liquidity. See that? The last high with the internal range liquidity. Took that out. You could have looked for some sell from these areas. And where are you targeting? Weak low. Look how quick the move is. Right into targets. Can you understand that? Right into the
But
targets.
in this
Okay.
case,
Yeah. Yeah.
where do we have a POI?
In here, yeah,
Yeah,
maybe on a higher time frame. Let's
there's
see.
a huge imbalance, and we swept the
Here it is.
liquidity. Yeah.
Here it is.
Okay.
See that? The body of the candle.
Yeah.
You can use it that way. Okay, so that's the thing. Use all the time frames. Okay,
Okay.
mainly use the higher time frame POIs, because that is why ICT always says higher time frame PD arrays. What are PD arrays? Premium and discount areas. Okay, premium and discount points of interest. That is a PD array. Okay, higher time frame one. See that? Right into the body of the candle, and here comes the drop. Very simple. See that? Very simple, but you can't even see that on a lower time frame.
Yeah.
What is there on a lower time frame? Nothing. Nothing. See that? But
Yes.
if you go to the higher time frame, everything makes sense. That's why I always ask you to stick to the higher time frames. Okay, stick to the higher time frames. Like if you go to the M1, you can easily, what's this? Unmitigated wick, lining up with the 4-hour wick. Sell it. Top plus above this high. Sell it. Where does price come into? See that? Very simple. Okay, very, very simple stuff. Like that. You could sell it here. Stop loss above that high. See, obviously, we're not going to do that. 1 pip. Okay, you can't do that. You can't do that.
Yeah.
Okay, if someone says they're doing that, you're lying. Okay, like I will always have something more than, yeah, something like 2 pips. Where am I targeting? Right here. Where did price come into? Straight into the targets. See that? Straight into the targets. Just like that. Easy. Very, very easy trade. This was the trade in range. Okay. This was the internal range liquidity. Right above that, we had the 4-hour point of interest right here. Refined it to a 1 minute. Like we did not refine it. We had this area marked. We just put our stop loss above a 1 minute point of interest. That's it. See that? We just put our, yeah, okay. See that? Stop loss above this. Where does price come into? Right into that, and it falls. See that? Can you understand that? I hope it's clear. Okay. Simple, right? Okay. And then again, okay, we had one cell right there. Okay. Now, this becomes a strong high, right? Why? Took out liquidity, broke structure. We have a QM. Yeah, we have a QM. Bam. Okay, so then strong high. Now, this is when things get interesting. Okay. Now, can you take this as the trading range? Here to here to here to here. What's that? Then a breakout structure, right? That's then a breakout structure. Now, what did I tell you at the beginning of the session? This is what I told you, eh? Stop punt, breakout structure, inducement, sell above that. And I told you, everyone will be taking this as a breakout structure. I told that you, but I told you it is not a breakout structure. Now, why is this not a breakout structure? Now, I'll tell you why. I told you For us to know that this strong high has created the weak low, it has to create a QM, right? It has to create a QM. But did this low create any QM? Did it run above any swing high? The three candle formation. Did it run above a swing high that created a lower low? Did it do this? Did this low do this? See that? No, it did not. See how important this is. See how important the three candle formation is. Did it do that? No, it did not. So can you take this low as a structural point? No. If you can't take that low as a structural point, can you use this as a structural point? No, because this low was the one that created the high. See that? And as a matter of fact, this right here was an Asian high. So why would you trust it to hold now? Inducement. See that? A perfect inducement. Just like that. It is not even a structural point. See that? You cannot take this as a breakout structure. Now, obviously, if you go to the 5-minute, you will have a break. That is why we use the higher time frame. See that? We do have a break. We do have a break on the 5-minute, but that is why we use the higher time frames. Do we have a break? No, we do not. See that? We do not have a break. Can you understand it? Okay. So then, what is your low then? We have the strong high. This is not the low. This is not the high. But here we have the low. Created a lower low and then broke structure. Then broke a swing high. See that? A swing high that, see, a QM. That's a QM, right? See that? Okay, so here we have the low right here. Okay, so if you're taking a trade here, where did price come into? Right into this imbalance. Tapped and then bam. Right into the target. So you had another sell right there. Easy, very, very easy. Okay, see, accumulation, I told you, Asia, accumulation, false run in the opposite direction, inducing bias into the market, and then what happened? Dropped. Okay, dropped back down. So that's the thing. I'll show you more examples, don't worry. Okay, like look what happened here. Now, many people would have looked at this as a breakout structure point, right? As a breakout structure point, they would have looked at it this way, and they would have taken this as a breakout structure. So imagine how many people would have wanted to buy from these areas. Okay, many people would have wanted to buy from those areas, and look at the reactions you get. You get good reactions, and look at this candle. Look how big that candle is, straight through it, straight through everyone that wanted to buy it. Okay, everyone gets stopped out. Like, yeah, you could have refined this maybe. You have the imbalance on the higher time frame. Let's see what we have. Yeah, I think we have a breaker. Yeah, it was a breaker. Let's go to the 5-minute. Yeah, there was no proper way of refining it. Right here we had the breaker. Yeah, see that breaker? Last, see? Can you see that breaker?
Last buy candle, right?
Yeah, not the buy candle. Okay, the down candle, see that? That is where they place the buy order to take this liquidity out. I told you about the breaker. Where is it? It's here, where the liquidity got taken out. Okay, so yeah, that is where the breaker is. So we had no way of refining it. Okay, we had no way of refining it. But if you go to the lower time frame, you could have taken a trade, a beautiful trade. Yeah, see this? What's the confirmation we need? That's it. Here we have that. A swing low. See that? Once again, a swing low. Higher low to the left, higher low to the right. What's that? Broken. Okay, like if you use the line chart, here's the confirmation we need. Okay, then what is all of this? Inducements. Okay, here is your sell zone. Sell it here. See that? Sell it here. Okay, sell it here, or else if this candle is too big, use the 50%. Like that. Use the 50%, sell it. See that? This whole area is your sell zone. This whole area. That's the sell zone. Okay, stop loss can be above this high maybe. And where are you targeting once again? The low of your trade in range. See that? The low of your trade in range.
Body of the last buy candle, right? The 1 minute.
Yeah, the body of the candle. Like that. Okay?
The top.
You can use it this way. Like this. See that?
We don't
You can use it
consider
that way.
big, right?
I'm sorry, I didn't hear you. Yeah?
We don't need to consider that big, right?
This
On the
week?
top. On
No,
the
you
top.
don't have to. You don't have to, because why? The inducement was right here. Okay, so what's the closest point of interest? It's this candle, right?
Yeah.
Not the wick. Not the wick. Never went into the wick. See that? never went into the wick. Now, yeah, let's assume that it was like, yeah, let's say the stop loss was too big or something. Okay, let's say the stop loss was too big or something. Okay, now let's wait and see how we could have gotten another entry. So you see we have a stop hunt here. See that? Stop hunt and a breakout structure. Major structure was broken here. Minor structure was broken here. Okay, so how do we know this strong high has created a weak low? Now this is a QM, right? This is a QM. This is a QM. So then this whole area becomes your point of interest, right? That becomes your point of interest. Yeah, we have this inducement. So let's wait until price gets there. Okay, tap into that, and that's it. You can sell it there. If you do not like this point of interest, you can sell it here. Stop loss can go above that high, 2 pips. And yeah, wait. Okay, it came up. No, dropped. No problem. Dropped. Okay, so that was safe. Yeah. Now this becomes another QM. See that? I think we might, yeah, I think we can expect sells. See that? You can just continue. Stop hunt. Yeah, let's see how this played out. Breakout structure. Okay, now, yeah, I think price is starting to come back up. We have a swing high. Let's wait for it to break. Okay, here it broke. Yeah, yeah, what's that?
This also has a QM.
That's the QM. See that? So you can take this as the trading range. That's why I told you.
This is not a valid swing. So can we consider it as a break?
A valid swing? Why is this not a valid swing?
This one.
Yeah, see that? Created a swing low
Oh, okay.
and then broke. See
Maybe
that?
in a 15 seconds or
Yeah,
maybe.
on a lower time frame for sure you can see that, but on the 1 minute itself you can see that. What's that? A very clear QM. See that? Bearish QM, bullish QM. What are you gonna do? This whole bullish QM becomes your point of interest, right? This whole area becomes your point of interest. Yeah, let's see. Let's look for a higher time frame point of interest. So we have this imbalance on the 5 minute. But what's missing? The inducement is missing, right? There is no liquidity resting below it. Let me refresh this once again. There is no proper liquidity resting below it. See that? Okay, so that's the reason. Now, this might be a little risky. Okay, this trade might be a little risky, but yeah, let's see how it played out. I think we were somewhere around here. Yeah, now let's see how it actually played out. This was the 5 minute imbalance. Something like a hidden base. Can you see that? Yeah, let's use that area. Let's see on the 15 minute, nothing. We had the wick. See that? 1 minute. Yeah, 1 minute hidden base 2. Okay, let's see how this played out. If it creates a swing high here, then it's gonna be high probable. Why? Liquidity. Ah, yes, here we have. Yes. See that? Inducement once again. Okay, because it's an algorithm that runs the market. Okay, because now the algorithm is programmed to run the same way because they can't make one algorithm for one time frame and another one for the other time frame, right? Because even though there is buy stops here or not, the algorithm identifies this swing high as liquidity. See that? Can you understand that? You could sell it here. Yeah, 2 pips, safe. It's safe, or else you can have it here itself because see, safe, 3.8 pips. Okay, no problem with that. So even if it decides to go here and taps this, no problem. But yeah, let's say we had a 2 pip stop loss. This should be your safest target. And what's your other target? Down here. Okay, the 15-minute traded range. So let's see. Okay, yeah, perfect. Yeah, didn't get stopped out. Okay, didn't get stopped out. Now we break even. Yeah, might even come back up. Yeah. Okay, let's see what happened. Okay, it's coming up. Created a QM, see that? Took out liquidity, broke structure, tapped. Yeah. See how if you train your eyes, it's gonna be awesome. Yes, created a bullish QM. See that? Bearish QM, bullish QM, into the bearish QM, and then comes the drop. See that? Endless opportunities. Retest, retest, re-entry. See that? All of these are re-entries. Let's see. Okay, into the targets. Done. We had another Beautiful sell. That's it. You saw that, right? How many opportunities did we have here? Bearish QM, bullish QM, into the bearish QM, sell it. See that? Can you understand that? I hope it's clear. Just like that. Okay, we have another sell. Okay, now let's wait. Now we are gonna take a huge sell. Okay, we're gonna take a huge sell. Why? What is your trade-in range now on the higher time frame? Your higher time frame trade-in range is from here to here, right? What confirms that? This break. Then all of this, now look at this. Yeah. Now, if you take this as a strong high and this as the weak low, okay? Now, can you expect sells from these areas? Can you? Yes, you can expect sells, but look at what they're doing. What's that? Trend line. Okay. So you don't want to enter with retail traders, right? You will get stopped out. You will get stopped out. So if this is your trade in range, what is this? Internal range liquidity. See that? Internal range liquidity. Then what you can do is look for the POI right above the internal range liquidity. See this? A very clear order block. See that? A very clear order block. Now you could do this. Why? Liquidity being fed into that point of interest. See that? Liquidity being fed into that point of interest. Okay, so you could just directly, yeah, we have these cells. Let's do it like that. Okay. Okay, liquidity being fed into that point of interest. So if you want to, you can put your stop loss above the strong high, target this low. That's a 1 to 11 if you do that. And it's very safe. Okay, stop loss is above a strong high. And see, this is an extremely premium price of this trading range. And even on the daily time frame, it's a premium price, right? So it has a lot of chance of playing out. Can you understand that? But for me, the stop loss was too big. So what I did was I refined it to the breaker. This is what I did. I refined it to the 5-minute breaker. Okay, see this? What is lining up with this order block? What is lining up with this order block? We have this 5-minute breaker. See that? Can you see that? A QM once again. Okay, that's a QM. See that? Okay. See that? So I told you this is where the breaker block is. Now, what's the logic behind this breaker block? Now, to take out all of these highs, okay, to take out these highs, okay, this is where the push up started. See that? This is where the push up started, which means they are placing a huge buy order from here, and then they are placing a huge sell order from here. Okay, so this is where they are in drawdown. See that? Now, what would you do if you were in a loss? If you were in a drawdown, you will wait until price gets into the break even at least, right? Break even at least. So same thing. They are not using stop losses. They will push price back and mitigate out of that loss. See that? They will push price back up into at least the break even. So this is where they are in a loss, right? From here. This is where the buying started. See, these candles never went above this high, which means this was the highest candle, and that highest candle was formed only after this push up from this swing low. Can you understand that? Okay. So I'm refining it to that. And then, so rather than having this whole area marked out, I'm selling it here. Now, remember, on MT4, you can't do this. You have to always factor in the spreads, okay? I'm just showing you my this trading view setup, okay? Yeah, I'm showing you my trading view setup. This is not the MT4 setup, actually. You know that. Okay, and then, yeah, you can wait. You can wait until price gets there. What happens? Okay, now imagine how many people would wait for this trend line to play out. A lot, right? And bam, into the entry. Everyone that wanted to sell from the trend line got stopped out. Okay, internal range liquidity is cleared. We are in the trade. Now, why is it high probable? Liquidity being cleared into the extreme premium price. Okay, inside of a daily premium price and a daily strong high. And we are inside of this. Okay, where are we targeting? Now, if I'm taking a sell here, this is where I'm targeting. See that? What happened? Bam. Look at the drop. Look at the drop. And then into the targets. Okay, into the targets. Now I don't risk 1% on any trade because like I'm trading a 100K FTM account. Like, why would I risk $1,000 on 2 pips? So that's a 50 standard lot size. And you know, living in Asia, it's hard. Okay, like $1,000 in my country, it's 200,000 rupees. So like, what if price just wicks above this and it falls? Think about my psychology. Like I'll be like, oh shit, I lost 200,000 rupees. Okay, so my psychology will not be able to bear up with that. Okay, so I'm only risking around $100 per trade. So if I risk, now that's the thing, if I risk $100 on this trade, what's my lot size? A 5 standard. Why? 5 standard into 2 pips, that's $100, right? 5 standard. And if I'm holding everything into this low, what's that? 4,500 pips, $4,500. See that? Like, what more do you need? That's enough, more than enough for the whole week because we're in an Asian country. Okay. And yeah, we're taking this sell, take your partials. Now I use something like a 4 standard because I told you on MT4 I can't do this, right? I can't do this. Okay, so I use something like a 4 standard, closed a 3 standard here, leaving a 1 standard into where? Into the daily, like this.
Okay.
See that? Daily to daily, right? Now look at the risk to reward ratio of 1 to 207. See that? Now that's not 207% of my account, but I'm just showing you. Okay, that is a 1 to 207 now. Okay, so yeah, we have that area marked out. Okay, so you understood the cell, right? How we used all of the concepts. Okay, yeah. Then we have another strong high. Why? Took out liquidity, broke major structure. Strong high. So where does my attention go into? The candle that took out the liquidity. See that? Like this. The last push up that swept the liquidity. That is where my attention goes towards. Can you understand that? Okay, because that is where the push up started to clear out the liquidity. Then let's wait for a breakout structure. And you can do two things. You can even, like I told you, you can wait until price gets here, or you can hedge it. Now see here we had a direct entry because why? It was in a premium price, extremely premium price, and it was a 1 hour small range. Okay, an order block. But here we can't take a direct entry, right? Like look at the size of this point of interest, a 40 pip range. Now, if you do this, like who would do this actually? It's always safe. Yeah, stop loss is not gonna get hit, but yeah, that's too much, right? Too much. So let's wait for a confirmation. Simple. You can either wait until price gets here, or you can hedge it. Okay, so what I did was see this QM for me. See that? Okay. Stop punt and a breakout structure. So I wanted to buy here. Look what happened. Okay, then shit happened. Came back down, created an inducement. See that? A short-term low. And yeah, wicked below my stop loss, and then it started going for some reason. I don't know. Things like that happen, so can't help it. I got stopped out. Okay, so yeah, now we have a trade in range from here to here, right? See that? Because why? Bullish QM, bullish QM. See that? A swing high got broken. Okay, or else you can even use this break. Yeah, you can even use this break. And then again, now this is how we could do ping pong. Okay. Can you hear me? Yeah. Okay. I thought I'm lagging or something. Okay. Now this is how you could do QM. Yeah.
Please wait.
Okay.
Okay. Your POI was here, right?
Yeah.
So it's a bit confusing for me. Why did you took your POI here?
Why? Because see, inducement was here. Let me show you what I used. Here it is.
Okay.
See that? What is this? Internal range liquidity, right? So I used that, and yeah, price just wicked below my stop loss and it started going. Can't help it. Okay, just wicked below my stop loss and it started going. So yeah, I got stopped out. Okay, so because I can't show you all of my wins, right? Like I'm getting stopped out too. Okay, so I got stopped out here. I got stopped out. Now, this is how you could do ping pong. Okay, look at this high right here. An unmitigated bearish QM. Stop hunt, breakout structure. See that? Unmitigated QM.
There is an inducement too, right?
Okay, exactly. We have an inducement too. See that? Okay, this right here is internal range liquidity of this. Okay, so what you can do is have that area marked out, inducement,
So
and
that
right
will
above the
will
inducement, yeah,
become our POI, right?
yeah, you can take the imbalance or as the wick, same thing. Yeah, both of them lining up in the same place. See that? You can use it like that. And then if you want to, you can go to a lower time frame and refine it. Yeah, you can put your stop loss above this high, see that? Above that high now. Can you understand it? Simple. Okay, you can have your stop loss above that high. Yeah. Then it's all about waiting. Okay, it's all about waiting. And let's see if we could hedge this thing. Okay, let's see if we could take a buy to sell or something like that. Okay, that is what I always do. Okay, so we have a strong low here. Why? Took out liquidity and broke structure, right? Broke structure. So we have a strong low. Let's see how this strong low. Let's wait until it creates a weak high. Here we have the break. See that? Not this, this. So what is your trade-in range now? What's your trade-in range? From here to here, right? That becomes your minor trade-in range. Okay, now we can work with all of them. Okay, we can work with all of them. So then first thing, discount and premium. And then what are we going to do? Internal range liquidity. So can you expect this order block to play out? No. What is that? Internal range
Our
liquidity.
balance above, and we have the internal liquidity just below
Yeah,
that
exactly.
balance.
What do you mean? This thing?
No, no, no.
This thing?
That thing. That
The
thing.
one that I marked, right? Yeah, the one that I marked.
No, no, no.
Okay.
I mean,
Yeah, then
this thing.
can you annotate? Yeah.
This one.
This thing? Now, why is this internal range liquidity? Why?
Uh,
Is this a swing low?
no, no. I
No, right?
thought that maybe in lower time frame
Not
it
a
is
swing
swing
low.
low. Okay.
Yeah, now we are working with this time frame now, okay? We're
Okay.
working with this time frame. So in this time frame, what is the main internal range liquidity? The last point is here, right?
Yeah.
Last point with here. Okay, last
This is
point
where
is
I'm
here.
getting more confused because
That's the thing. That's the thing. On a lower time frame, for sure you will have that. For sure, this is internal range liquidity on a lower time frame. Okay, but then again, that's why I told you, stick to the higher time frames. Stick to the higher time frame now. Now you know what a higher time frame is actually. Since this is your highest time frame trade in range, okay,
Mhm.
this is your higher time frame on this trade. See that on the 5 minute.
Yeah.
Can you understand that? Okay, so you have to always use it that way. So right below this, what do we have? An imbalance
Okay.
or the wick. We have the wick right below that. Okay, so if you go to the 15-minute, the body of the candle that took out the liquidity is never mitigated.
Yeah.
See that? The body is never mitigated and there is internal range liquidity being fed into that. Okay, so you could go to a maybe a 5 minute or the 1 minute. I took it like I did not take it actually. I'll show you why. Okay, this was the 1 minute. Okay, what did we have? Equal lows. See that? Equal
Yeah.
lows
Right.
right above the point of interest, and we had this order block never tested right again. See that? Never
Okay.
mitigated, never mitigated. So stop loss below this. See that?
Okay.
Stop loss below this now. Okay, see, we're not moving this area because this is where the 15-minute point of interest was. We're only taking our stop loss to here. Can you understand that? Like that. Okay, like that. And then, like honestly, I was waiting until London does that. Okay, I was waiting if London was to do that, but no, it played out during Asia. Okay, so I don't trade Asia, so I missed it. It started coming, and yeah, this was Asia. Built another inducement, and yeah, tapped. This was Asia, so I could not take it. So let's mark out the Asian session. Starts at 3:30. Yeah, see that? Oh yeah, it started at 2:30 those days, and then
Oh,
set
9:30,
9.
right? Yeah.
Yeah, those days. Okay, now after November there was daylight savings time, so then it's from 10:30 to then it's from 10:30 to 2:30, I guess 10:30 to 3:30 right now.
Okay.
Okay, because of the daylight savings thing. Okay, so it played out during Asia. See that? Like even during Asia, look at the reaction once it comes into those areas. Okay, like yeah, that was a good Asian session trade. We couldn't take it. Okay, but yeah, like I had this area marked and I saw Asia playing it out perfectly. So can't help it. Okay, so let's wait. Let's wait and see what's happening. Came back down.
So
Okay, it has
in this
broken
case,
structure.
in this case,
Hmm?
um,
Yeah,
sh- can we look for a buy at the 50% mitigation of that Asia session, like
Asian
previous
range.
before?
Yeah, no problem with that. Okay, no problem with that. You could have even taken a buy from the 50%. Okay, 50%. But now look at this time and price. London has opened and we are inside of a sell zone.
Okay, yeah, right.
See that? We are inside of a sell zone. And if we take a sell here, okay, if we take a sell here, can you expect this to hold? No. Asia has created a QM.
Yeah.
See that? Asia has created a QM. So which means this low is a strong low, right? This low is a strong low. Now let's sell it here first. Okay. Stop loss was somewhere around here for 3 pips. Okay, now a strong low is created. Let's mark that out too. Strong low created right here. How do we know the strong low has created a weak high? It has to break a swing low, right? Like this, a swing low. Okay, what's that? We want to see a bearish QM. Okay, so let's wait. Look at the drop. Okay, here we have the bearish QM now. See that? Swing low is broken. Oh, what's that? Line chart here. Yeah, here it is. See that? A swing low is broken now. Okay, a swing low is broken. So we have a new trade in range. What's that? From this low to this high. See that? That's our trade in range. So if this is our trade in range, okay, what's this? Internal range liquidity. See that? Target that. Like you see how consistent we are, right? Same thing again and again. Same thing again and again on every single time frame. Okay. So we have this as our internal range liquidity. That is what we're targeting. Right below the internal range liquidity, what did we have? An imbalance plus the candle that took out the liquidity during Asia. See that? Imbalance plus this candle. Okay. So if this area is too big, go to a lower time frame, refine it. How are you refining? Put your stop loss below the breaker. See that? Below the breaker. Okay. And then it's about waiting until price gets there. Okay, wait until price gets there. Like this. We had this break. Set your limit here, or else you can just set an alert here, and when price gets there, you can do a market execution. But no, I set a limit like this. Where are you targeting? This high as your first target. So let's wait. Let's wait. Messing around, messing around. Look at that. Right to the pip. Okay, right to the pip, and look at the rejection. Okay, look at the rejection. No drawdown basically. Okay, like that. Yeah. And you have a sell, and you have this buy. Okay, so what happened? Look at this thing. instant profits. See that? Right into the targets. Okay. Yeah, this is ping pong now. See now, like, did I even go to a 1 minute time frame? No, right? Why would you go to the 1 minute time frame when you can do ping pong with this? Okay, like no reason to go into 1 minute. Okay, now this, look at this. What's happening? We are reaching. Okay, we are reaching a sell zone, right? We are reaching a sell zone. Now we are currently inside of a sell zone. What do you want to see? That's it. A QM. Okay, a QM. So let's wait. Let's wait.
Those swings will become inducements or
Yeah,
liquidity, right?
these
Those
highs.
swings which are inside the zone. Yeah.
Yeah, exactly. Or they might be inducements, but on the 1 hour you could not see this. See that? On the 1 hour, those were not swing highs. That is the reason why I marked this whole candle out. See that? That's the reason why I marked this whole candle out. We do not know. Okay, we do not know. So now we have a huge range. Okay, yeah, this POI is a 40 pip range, so we can't just directly sell it from here, right? Like I said. Okay, yeah, let me refresh this once again. You see how important trading ranges are now, right? You can just play, yeah, you can just play along with it. Okay, so when price gets here, now what do we want to see? Okay, now price is inside of that. And here we have our confirmation. That's it, right? See that? Stop hunt, breakout structure. So we have our confirmation. A stop hunt from a swing high and a low that got broken. Okay, a low is broken like this. Okay, the low is broken. Okay, confirmed. Cells are confirmed, but we still couldn't get an entry, right? We could not get an entry yet. Okay, so let's see. Yeah, where did this actually come into? It came into somewhere around here. Yeah, we don't know. No problem. Let's see. Let's see, where did it come into? I think it was 50% of this week. No, not even that. Let's go to the 30-minute. Yeah, no idea. No problem. No problem. Okay, but now we have gotten our confirmation, right? We have got the confirmation. So same thing. Now it's like too late in the day. See that? 12 a.m. Okay, like we're not trading at this time. Let's wait for Asia to end. Let's wait for the next day to start. Okay, same thing. Let's wait for the next day to start. Yeah, let's wait. This is Asia. Okay, Asia is over. Now this is when we look for our setups, right? This is when we're going to look for the setups. So let's wait and see if Asia is building up the context for London. Yeah. Now look at this. Today, can we trust Asian high, or are we expecting it to break? We're not going to expect it to break. Why? Asia has done a stop hunt and it has given us a breakout structure. See that? Now, can you wait for Asian highs to get taken out and for price to tap into this? No. Why? Asian high is a strong high, right? It's about taking a risk now. It's all about taking a risk. If you use the line chart, okay, yeah, here we have the QM. See that? We have a QM now that Asia created. Okay, we have a QM that Asia created. See, stop hunt, breakout structure. Okay, now then this becomes the strong high, right? This becomes the strong high. How do we know the strong high has created a weak low? A swing high has to get broken once again. And yeah, London opened, and here we have that break.
We have an inducement above.
Exactly. Okay, now this becomes your trade in range. If this is the trade in range, what's this? Internal range. Like that. Now you don't even have to have a point of interest. Okay, because you know that this is liquidity. You know that this is the strong high. Just set a limit like a pip above that. Stop loss above the strong high. Like, why would you want a point of interest now? See that? 2 pips. Okay, like, why do you want a point of interest? You can do this. Yeah.
Most of the time, the Asian highs will behave like a strong high or strong
No,
low.
not most of the time. Okay, not most of the time. Only if price does this. Okay, only if price does this. And yeah, we are even
If you
inside of
guys
a
were
point of
evaluating
interest.
some of the previous highs, then
Previous highs.
okay, okay.
Exactly. Then you can expect it to hold. Okay, then you can expect it to hold. Like, see, even in this example, it took out liquidity, right? That is why it held.
Yeah.
See that?
Otherwise, it will
That is why it held.
get manipulated.
Otherwise, it will get taken out. Okay, otherwise, it will get taken out. But yeah, sometimes they can go without doing it. But yeah, most of the time, it will get taken out. Okay, yeah. And see, this
Do
is
you have
even
any
inside of a
indicators
point of
for
interest.
these?
Asian
I
highs.
have seen. I have seen
Yeah, I
in many
think
of the
there was
videos using
something.
Asian range.
I think yeah, I think it's this. Some people are using this, but you have to set your you have to make the timings properly because the timing that is wrong. See that? Okay, so yeah, I don't use indicators. I just do this. Okay, yeah. And if I'm taking a sell here, this should be my first target where I can partial out. Okay, see that? Look at the rejection, instant, and then bam, target's hit. Okay, that's it. Very simple. What are you doing? Take your partials, leave a runner. Okay, leave a runner into where? Into the higher time frame low first, right here. Right? You're leaving a runner into this. But look what happened. I got stopped out. Price came back up. Spread stopped me out at break even. And then what happened? Bam. Stopped me out at break even and then it dropped. Like I could have gotten an entry here. Why? We had another QM. Stop hunt, breakout structure. See that? Like we had another QM. Like I could have gotten a sell, but yeah, I did not do that for some reason. Like, see, you could have taken it easily. See this? Stop hunt, breakout structure. Here we have a break right here. After breaking below this low, price came up, created an inducement, tapped into somewhere around here, and then it dropped. Okay, I didn't take it. I didn't take it, so no point of looking at it even. Okay, so yeah, it stopped me out at break even spreads, and then it dropped. Okay, so if you were in that trade, what you could have done is taken another portion off from here and leave it into the daily lows. See that? That is what we could do. 1 to 207, 1 to 168. Look at the risk to reward ratios. Okay, and we're pretty much trading everything up and down, up and down. Okay, so you can do that. And then, yeah, it's about waiting until price comes into your point of interest once again. Okay, let's wait. Let's wait because look how it's dropping. Okay, look how it's dropping. It's like no re-entries, right? You can see how it's dropping. No re-entries for sure. So let's wait until it comes into a point of interest. Okay, it's starting to come back down. Okay, we are inside of this. Now, what do you want to see? That's it, right?
Bullish
The
QM.
only confirmation we need. Yeah, a bullish QM. Okay, a bullish QM. Go to a lower time frame. Wait until price gives you that. Okay, let's wait. Let's wait. Like, see, we don't even care about any of this, right? We don't even care about that because why? This is our point of interest. Why should we even look at that stuff? Like, but yeah, you could have entries. You could have gotten everything. See this? Stop hunt, breakout structure, inducement,
Inducement.
sell,
Yeah.
targets. Very simple. Okay, you could have done that. You could have done that. But yeah, let's wait. Let's wait until we get the confirmation. And here we have it. See that? Yeah, this was an early entry. Stop hunt, breakout structure, enter here. You could have done that, but no, I didn't do that. I was waiting for a little more confirmation. Stop hunt.
That might be in 1 minute time frame, right?
Yeah, for sure on the 1 minute. For sure on the 1 minute. See that?
But might be a risky one.
Uh, it is very risky because where's the liquidity? No liquidity. See that? So yeah, we can't take this as inducements and wait for this to get played out. Okay, so yeah, I won't do that. And yeah, let's wait now. We have the confirmation we need. Okay, now why is this QM very special? Because it's happening inside of a 4-hour point of interest, right?
Yeah.
That is why it's special. Okay, yeah. Then yeah, same stuff. What are we gonna do? Wait for Asia to end. Wait for Asia to end. Okay, same stuff. I think yeah, this is November, so now the Asian times are different. Yeah, now Asia is at 10:30. Yeah, Asia ends at 10:30 now. Starts at 3:30. Like this. Okay, now what did Asia
Session
leave
timing
behind?
changes.
Yeah,
Session
on
timing
November, bro.
changes during the months, right?
Yeah, on November, I guess.
November.
On November it changes. Yeah.
Oh.
Okay, because of the daylight savings
Yes.
thing. I don't know properly. Yeah, I don't know properly because that happens because of daylight savings time. But yeah, you can if you just look into Forex Factory, you can see that they will just update it.
Okay.
Okay, they will update it all the time. Okay. So look at this. Now, today is the Asian low strong? No, right? What did they leave behind? Equal lows. See that? Equal lows. Can we trust it today? No. So right below that, we have this point of interest. Why is it high probable? Asian sessions liquidity being fed into that point of interest. See that?
Yeah.
Liquidity, like feeding into the point of interest. Have that marked out. Now, like I said, you can do one of two things. Okay, you can either wait until price gets here and then buy it, or else you can always hedge it. I told you, right? You can always hedge it like we do. Okay, so yeah, now right now we do not have a proper point of interest. So what I did was I was waiting until I get a clear setup. Now look what happened. Okay, so the price went up. Okay, took out the Asian highs. Right here now, the thing is now after it's gone, I can easily explain this to you, right? But what once we're looking at it in real time, like it'll be a little confusing, right? It'll be a little confusing. Okay, so for some reason, okay, I took this as a stop hunt and this as a breakout structure. Okay, I took this as the breakout structure, but where is the major breakout structure? Here. See that? Price can still do this. Price can still do this, right? But I took this as a stop hunt and this as the breakout structure because why? A QM was formed. See that? The QM was formed after taking out Asian highs. So then what I did was I took this as the strong high. Okay, was waiting until it gives me a bullish QM. Was waiting, patiently waiting. And here we have the QM. See that? Okay. So what's your trade in range? I got it from here to here. Then what is this? Internal range liquidity, right? Okay. And since the stop loss was too small, I sold it right here. See that? 1.7 pips. I did this. Okay. I did this. Like right above the liquidity, right with the liquidity, and I was targeting the Asian lows. Like this. Okay. I was targeting the Asian lows. And then look at the reaction though. Okay. Into the entry, bam. Okay, straight into that. Then I moved it to break even. And only then I realized that this was the real breakout structure point. Okay. Yeah, on the higher time frame. Okay, maybe on a 5 minute or 15 minute, exactly. Okay, yeah, on the 15 minute. Okay, this was the proper trade in range. Okay, this was the proper breakout structure. Now I have moved it to break even. Okay, price went up. Now I'm already at break even. Okay, so now this is when price broke structure. See that? This is when the proper breakout structure happened. Can you see that? That is when the proper breakout structure happened. So if this is the proper breakout structure, once it's coming back up, this will be acting as internal range liquidity, right? Yeah. Okay. So then I knew I'm getting a break even. So see that imbalance right above that? I sold it here. Once again, 2 pips. Okay. Now London has also opened. So timing is perfect. Let's wait. Let's wait. So yeah, I got a break even that day. Now, yeah, see that? Tapped, and now it's coming back down. Okay, tapped, and it's coming back down. London has also opened. No, London kill zone has opened, not the session yet. We're hedging it until here. Okay, we are hedging it until here. What happened? Well, it's coming back down, it's falling. Okay, look at the drop. Okay, now look at the drop here. Imagine, I told you, right? Falls run in the opposite direction. The sessions will always open with fake moves. Imagine how many people would have thought that London is going to be bearish. Look at the drop. And what have we been taught? Do not catch a falling knife, right? Who would want to buy this thing? Look how it's falling. Who would want to buy this thing with this huge momentum? Look at that. Look at the drop. Okay, but yeah, we don't fear that because we know these are inducements. Okay, these are inducements. So what we're going to do is take out everything here, right below the Asian low, we're buying it. Right below the Asian low, we're buying it. Like this, 2 pip stop loss. Okay, now look at this. Now you cannot hold this into like 1 to 50, so 1 to 100, so anything. Why? It was directly based off a 1 minute point of interest, right? But this could be held for a long time. Why? It's coming from the 4-hour point of interest. That it is not just a 1 minute, it is not just a 5 minute order block. It is coming from the 4-hour point of interest. Okay. Yeah, let me refresh this once more. And yeah. Okay. See that? So you can understand that, right? Why are we not gonna hold this? Okay, but why are we gonna hold this? It's coming from a higher time frame point of interest, which means higher time frame targets. See all of these equal highs. Okay, so we can target that. Now look at that. That's a 1 to 40 now. Okay, you can have those as targets, but remember, always take your partials at some points. Okay, and yeah, price is dropping, tapped, and now it's going. Okay, like that's the thing. As soon as you get tagged in, you will get a reaction. Okay, see the rejection, and then yeah, it started going up. Now, what's your trade in range on the 4-hour? Make sure you work with the 4-hour trade in ranges once again. This was your strong high, right? This was your strong high. Let me delete all of this. It's messy. Can you see that? Took out liquidity, broke struck the strong high. How do we know the strong high has created a weak low? Here we have a break. Bullish QM formed. See that? Bullish QM was formed. Stop hunt, breakout structure. Okay, the bullish QM was formed. And then what happened? Okay, what's your trade in range now from here to here, right? That's your trade in range. Discount and premium. So price has to come at least into this level, right? Before falling back down. Okay, so I was waiting for this internal range liquid to get cleared out and a tap into this. But what happened? Okay, it went up, took out the internal range liquidity, Okay, and yeah, before going into a premium price, it fell back down. Okay, so I could not take the sell because I was expecting a tap into the equilibrium. Okay, so yeah, can't help it. I missed the trade, but yeah, it was always safe, right? Because I stick to my rules. Okay, took out liquidity, broke structure, makes this a strong high now. Okay, no problem because why? Cells are still running. Okay, cells are still running. Okay, like see in total, this is like a 1 to 368. Okay, yeah, crazy. Yeah. Now, once again, look at the drop. Now, like there's no point of like looking for sales, right? Look at the drop. Okay, like we'll have to wait now. We'll have to wait until price gets here. So when price comes here, what do you want to see once again? That's it. Okay. So yeah, price is falling. Okay. Tapped right into this. Now this day I set a limit on this sell and I deleted it for some reason. Look at this. Okay, first mark out Asia. Okay, first thing, mark out the Asian range like this. Okay. Okay, so right above Asia, okay, right above Asia, we had a 1 minute point of interest. Okay, we had a 1 minute point of interest that was not tapped. See that? Can you see that? Right here, we had this 1 minute point of interest and it was not mitigated yet. But the thing is, I told you, right, for it to be a strong high, it has to, now, yeah, it has taken out liquidity though, but it did break structure. No, it did not break structure. So I did not expect this to play out. Okay, so I set it right away and then I deleted it. I thought this highs would get taken out. Okay, but what happened? Tapped and melted. Okay, so missed it. So yeah, can't help it. Okay, it just tapped and look at the drop straight into the targets. Okay, like a very quick drop. I told you, right? A false run in the opposite direction. Okay, maybe a false run in the opposite direction because why? We are coming into a 4-hour point of interest now. So what do you want to see? When price comes here, a bullish QM. Simply wait, patiently wait, patiently wait. And here we have a QM right here. See that?
And on a higher time frame POI, when we are
Yeah,
entering into a higher time frame POI, in
yeah.
which time frame should we look for a bullish
Now it's like this. Okay, if you go to the 1 minute, okay, if you go to the 1 minute, you can always get an early entry. Okay, a very early entry, you can get one. But remember, it is always risky. Okay, because why? When price tapped here, maybe on the 1 minute, you would have had a QM here. Then you'll get stopped out. See that? So it's always better to look for the higher time frames like the 5 minute or the 15 minute. It's always better to wait for that. Okay, but if you go to a 1 minute, for sure you can get an early entry from here maybe, but it is risky. Okay, it is always risky. Keep that in mind. So that's like sometimes I do go to a 1 minute. Okay, yeah, that's not a problem, but keep in mind it's always risky. Okay, always at your own risk. Okay, yeah. So we have this QM. See that? Stop hunt, breakout structure inside of a point of interest. See, now in here, no QMs. This is where they gave the QM. This. Okay. So yeah, you have the stop hunt, you have the breakout structure. Then where do your focus go towards? The candle that took out the liquidity, right? Okay. Let's wait for the inducement. Okay, here we have that. Like, I'm pretty sure nobody took this. Okay, I'm pretty sure nobody took this because why? This happened during NFP. Do you know how spreads how wild the spreads goes, right? During NFP. Okay, so yeah, price just it was messing around, and with NFP, bam, time and price. Look at the time, right at 6 p.m. Okay, into the breaker, like yeah, I wanted to buy this right here, but my spreads showed me that if I bought it here, my buy would have placed right here. Okay, so look at the stop loss then. Okay, I didn't want that. Yeah, that was a 20 pip stop loss. Who would want that? Okay, so yeah, no problem. I was patiently waiting because even on the 15 minute, shit, it's lagging. Okay, even on the 15 minute, we had a QM. See that? Stop hunt, breakout structure. Okay, so yeah, see that? A QM. Okay, a QM. So let's mark out the strong low and let's wait for the strong low to create a weak high. How do we know that? Bearish QM, right? bearish QA. Okay, so price is starting to go up. Let's wait. And here we have it. Okay, here we have a breakout structure. So mark out your trading range. So what do you want to do? I told you, right? Always use the higher time frame POIs. Okay, so inside of the 15-minute trading range, we had a 4-hour point of interest. See that? The example that I showed you earlier. Okay, the volume is in the body. Now let's add confluence into this point of interest. Okay, now we have the 4-hour order block, 15-minute breaker block. Okay, and it is inside of a discounted price of this trading range. Okay, let's add more confluence. If you go to the 5-minute, we have now the 4-hour order block. Okay, 15-minute breaker block, 5-minute breaker block, 5-minute order block, all in the same place. See that? All in the same place. Why? That means smart money was up to something in this area, right? They were up to something in this area. And most importantly, we have liquidity being fed into that. See that? Short-term low. Never tapped the body of this order block. See that? Never tapped it. Okay, never tapped it. So you can use that. And yeah, let's see. Let's mark out Asia. Now you know what to do. You can either wait until price gets there, or else you can hedge it, like I told you. Okay, you can always hedge it. Now this day, can you expect Asian highs to hold? Yeah, for now. Why? It has taken out liquidity and broken structure, right? Major structure broken here and minor structure was broken here. So how do we know? Yeah, let's mark out that. How do we know this strong high has created a weak low? You have to get a breakout structure in the opposite direction, right? So let's wait. Okay, here have a break of, here we have a break of a swing high. See that? We have a break like that. Okay, we have that. So if that's a break, then this becomes your trading range. And what is this? Internal range liquidity. Okay, now remember, if it comes here during Asia, we're not going to trade. We're not going to take it. Okay, it misses, it goes, because we're not going to trade during Asia. But if it comes after Asia, then yes, we can trade it. Okay, yeah, after Asia. Okay, now we can trade it, because why? Stick to the rules. Okay, stick to the rules like this. Sell limit on the imbalance. See that? See that imbalance? Okay. Stop loss can be above the strong high, or is that imbalanced candle. Where are you targeting? Asian low, safest target. Okay, safest target. Price then messed around. Okay, yeah, London has opened. Yeah, London kill zone has opened. Huh, look at that. Tapped into our entry. Then what happened? Bam, melted. Okay, straight into the targets. Okay, so we can take our partials. Okay, from that low, take your partials from the low, and then leave a runner into this inducement. See that? Into this. Like that. So what happened? Bam. Okay, so it's coming back down. You have taken your partials, you can leave a runner, or else you can even close everything. Now, same thing. Like, can you see how similar this setup is into that previous setup we used? We can either hedge this, and I told you, right? Who would want to buy this thing? It's like catching a falling knife. Didn't I tell you that? Same stuff. Okay, same stuff happening again and again. We hedged it, and now we're buying it from the low. Okay, we're going to buy it. Okay, now I'm setting my limit here. This was a 5 pip stop loss actually on MT4. You see it was 4.6 pips here. And I was targeting this high with the 2 standard. Bam. Look at the rejection. See that? Look at the rejection when it taps here. Just like that. And what happened? This is what is this? A false run in the opposite direction. Okay, inducing sellers into the market. Now imagine how many people would have thought that London is going to be bearish. Okay, but what happened? Bam. Judas swing. See the Judas swing.
Yeah.
Okay, yeah, everyone got stopped out, and now price is going up. Now it's going up. Now look at this. Now we can't hold this into something like a 1 to 50 or something. Why? Directly based off a 5-minute imbalance. But this we can hold it. Why? 4-hour point of interest. Like, see how similar the setups are, right? Very consistent. Okay, very, very consistent. And then into the targets. Just like that.
So you have that. And yeah, the 4-hour structure was broken right here. Okay, so let's go to the 4-hour time frame. Yeah, on the 4-hour, this was the strong high, right? This was the strong high. And how do we know the strong high has created a weak low? Here we have the break. See that? QM, bullish QM. Okay, so then from here to here is your new trade in range. So what are we going to do? Once we find out the new trade in range, look for discount and premium prices. And this buy can be held until at least the equilibrium, right? Like this. Or else this whole area is your point of interest, right? Last push up before the push down. So on the daily, what's that? An order block. See that? On the daily, that's an order block. So you could refine it to the breaker block on the 4-hour. And if you go even lower, okay, if you go lower, see this? You can use these candles now. Can you see that? You can use these areas lining up with the breaker. Okay, see this? The 15-minute candles, you could have used that. Okay, you could have used that. And yeah, then it's about waiting until price gets into these areas. Because why? Okay, because why? Even though we refined it, this was a higher time frame point of interest, right? It was a higher time frame point of interest. So it's always safe to get a confirmation entry. Can you understand that? Okay, we're going to get a confirmation entry. So you took your partials already. Now you can hold a runner into these areas. Okay, and then let's wait and see what's happening. It's going up. It's going up. Okay, now, yeah, Asia started. So let's wait for Asia to end. Asia ends at 10:30. Let's wait. Right here. Okay, fucking shit. It's lagging. Give me a second. Okay, Asia has started. Okay. Now look at this. Okay, now Asia is over. So what can you do? You can either wait until price gets here, or else you can always hedge it, right? I told you. You can always hedge it if you want to. So this day, okay, so this day, let's see how we could take a trade based off the Asian session. So right now, can we trust the Asian lows to hold? Yeah, right? Why? Took out liquidity and broke structure. See that? And confluence of events lining up with the Asian midline. What did we have? A strong low once again. See that? Took out liquidity, broke structure. Can you see that? Broke structure. Okay. And right below that, what did we have? An imbalance or a disorder block, both lining in the same place. See that? Both lining up at the same place. Where did price come into? See this? Liquidity was formed. Okay, so I had a buy right here. Stop loss below that low. 2 pips. Where am I targeting? This high. Safest target. Okay, safest target. And what happened? Bam. Very quick. Okay, into the targets. Take your partials. Leave a runner. Like this. Into these areas. And you know what to do when price gets here. That's it, right? That's all you want to see. Okay, that is all you want to see. So let's wait. Okay. Tapped into that 15-minute breaker. Let's wait for our confirmation. Okay, let's wait for the confirmation. Okay. Now here we have that. See that? Stop hunt. Break of structure. Confirmed. Okay, confirmed sell from the higher time frame point of interest. Now look at this. Okay, only if you get the trading range properly, you can get this. Even this little buy right here. Okay, even that little buy. Where did it come from? This was your high time frame trading range, right? From here to here. Okay, look at where this buy came from. See that? Discounted price before going up. That's why I told you it always comes there. See, even this little area came into a discounted price before going up once again. Okay, that's the thing. If you get the proper trading range, that's how it goes. Okay. Now on the 1 minute, it's we are in a premium price now inside of a higher time frame POI. and we are inside of a, yeah, I'm sorry, not inside of a, we have gotten a break of structure 2. Okay, we have got a break of structure 2. Okay, in those previous examples, we waited for internal range liquid to get taken out and then a cell above that, right? Maybe at least this. Okay, at least this. But yeah, in this example, look what happened. I told you, right? Pay attention to how price is pulling back towards the point of interest. What are they doing?
Inducements.
Building up
Filling
liquidity.
up liquidity.
Inducements, exactly. Yeah, now you have to willing to be, yeah, you have to be willing to take a risk here, right? Why? Liquidity below the point of interest. Now they can come here and then fall, or else do this. We do not know. But if you do this, stop loss above the strong high, you're always safe. Okay, keep that in mind. Okay, you're always safe, but we don't like that, right? Like I'd rather get stopped out and then enter once again rather than having a 9 pip stop loss. Okay, and yeah, price tapped into our point of interest. Okay, what happened? Bam. Okay, we are getting our partials. No, not partials. We're moving it to break even. You could have just taken partials from the Asian lows or something and then leave a runner into the, why? Now, see, this cannot be held for a long time, but this can. Why? Higher time frame point of interest, right? Higher time frame point of interest. So, higher time frame targets into the 4-hour low, or else the daily low itself now. Okay, so what happened? Now that's a 1 to 63. Go to the 1 hour, and it's about waiting now. Okay, let's wait, and then done. Finally, see that? So daily to daily storyline is completed. See that? From here to here was the trade in range, and you saw how many opportunities we had, right? Intraday to swing, okay? Lower time frame entries, higher time frame targets. That's it. Okay, lower time frame entries, higher time frame targets. So now you see that, right? We do not have to deal a lot with the 1 minute. Okay, or you like even if you're not doing that, you can just do this ping pong stuff, up and down. See that now we have done ping pong on a higher time frame. See that? Up and down, up and down. See, now if you look at market structure, now see how clear market structure is. What can you expect once again? Can you understand it? Okay, can you understand that? So this is how you mark out your, yeah, see, exactly. This is how you can properly mark out your trading ranges and then play along with that. Can you, yeah, I hope you understood this, yeah?
Yeah, sure.
Like this is all I do. Okay, this is all I basically do. Okay, mark out the trading ranges, play along with them. Okay, play along with them. That is all you should do. Okay, that is all you should do. Like now, yeah, like it is very simple, very simple. Like you would have seen, I put a breakdown of this trade. I posted a breakdown of this trade. It was the same stuff: high, low. Now see, this was the high, this was the low. Went into a premium price, tapped into this. When price tapped into that, okay, a bearish QM was formed. See this? Okay, bearish QM was formed right here. Okay, so how do we know this strong high has created a weak low? Intermediate structure broke right here. Asian session. Yeah, Asian set 10:30 starts at 3:30 right here. See that? Asian session as an inducement. Okay, Asian session as an inducement, and what else? Internal range liquidity of this trading range was right here. See that? Sell above that. Sell right above that at this imbalance. No drawdown. So you're selling it here. Right here. Stop loss above that high. This should be your first target, and then leave a runner into the 4-hour low. Like this. See that? Simple. Very, very simple. Okay, same stuff. Okay, using the same stuff that I taught you. See, you could have just keep on trading this, and like look how clean this is. Okay, look how clean this is, the Asian range thing. Okay, so yeah, this day it did not, but look at this day. We have this Asian highs. Asian highs. Right above the Asian high, what did we have? Imbalance.
See that? Sell it. London Open, sell it. See? Asian range, false run in the opposite direction, inducing buyers into the market, and then comes the drop. Sell it. Like this. Okay. Yeah, it fell until here. Sell it. And then same thing. On this day, we had the Asian session. Like this. Right above Asia, what did we have? Okay, right above Asia, we have this unmitigated wick. See that? Unmitigated wick. Where did price come into? Right into the wick. Sell it. London Open. See? Asia, false run in the opposite direction, inducing buyers into the market. Sell it. Can you understand it? Okay, same stuff. Selling it right here. Like this. And even this day, look how it goes. Where was Asia? Right here, I guess. Okay, this is Asia. Okay, so right above Asia, what did we have? Unmitigated wick. Sell it. Can you see that? How it goes? Sell it right here. Stop loss can be on some lower time frame point of interest. I don't know. Like I did take the sales, but yeah, like this. And see how fractal price is. If it takes out Asian high, it drops down. Okay, but if it takes out the Asian lows first, what happens? It will go up. See that? Inducing sellers into the market and then they're going up. What did they do here? Induced buyers into the market and then they fell back down. So here, took out the Asian lows, induced buyers into the market, started going up. Like, look how beautiful the charts are now. Look at that. Okay, you're just playing along with them. Okay, so yeah, now since we have this bullish QM now, we have the stop punt and a breakout structure. Now I'm waiting for this unmitigated wick to play out on Monday or tomorrow. We have all of these inducements. This is what I'm expecting. Like this. I don't know if it plays out. I'm just showing you what I'm expecting. We have the 4-hour wick unmitigated, 1 hour wick unmitigated, 15-minute wick unmitigated, liquidity right above that. Yeah, let me delete all of that. Liquidity right above the wick. And on the 4-hour, this is the first time they broke a swing high. So our major breakout structure was still bearish. Okay, so you could take this as the trading range from here.
There, right?
Yeah, we have a QM. See that? We have a QM. So this right here, yeah, this right here was a bearish QM. Okay, and inside of this trading range, yeah, inside of that trading range, we have the weekly point of interest. Like this. So I'm looking into this now. I'm looking into this. And yeah, on Monday, if the setup plays out, you can buy from this wick until these areas. And if you're taking a buy and if it plays out, okay, remember to hold this trade. Okay, this can be a swing trade. Because why? The daily structure is broken, right? The daily major breakout structure was here. Now, since we have broken out of the daily range, what if they decide to break out of this? Then your daily trading range is from here to here, right? Then if you're taking a buy here and if you can hold it like this until these areas. Okay, so keep in mind if you're looking for buys, okay, it's gonna be sometimes, okay, maybe it's gonna be a swing trade. If it breaks above these highs, it's gonna be a swing trade. Okay, but make sure you look for sales from these areas too. Okay, from a premium price of the current trading range. Okay, so yeah, this is all I do. So is it clear? Yeah. Do you have any other questions?
The POI that you took at the last moment. Please
Here?
show me that. Yeah.
Yeah,
Can you
sure.
explain why you took that POI?
Yeah, sure.
Because
So
I'm
we
seeing
have
liquidity
this.
over there.
Okay, let's see.
Okay.
We have this top hunt.
Mm-hmm.
We have this breakout structure.
Yeah.
Okay, and then price started going up. The range was created. So inside of that trading range, high time frame point of interest. What's that? We have this wick. See that? The 4-hour wick that cleared out the liquidity. Okay, so lining up with the 4-hour wick, we have the little 1-hour wick. Okay, or else let's have it like that. And then if you go to the 15-minute, you have the 15-minute wick lining up with that same place. See that?
lining up with that same area, you have that, or as the 15-minute breaker too. Do not over refine it. See that? All of that area in one place and liquidity resting right above that. So I told you, right? When there is a higher time frame point of interest lining up with those areas, you can't expect this internal range liquid to get taken out too. Didn't I tell you that? Okay. So that's the thing. Yeah, you have to. Let's see. Let's see. This is what I'm looking at. Yeah.
Can you please explain the breaker once more? I'm a
Yeah.
little
A breaker
confused with
is
that.
something like this.
Okay.
Okay. The breaker is something like this. Okay. A QM. That is what you want to see. Once again, a QM, and the area where structure broke, that is where the breaker is. See this?
Oh, okay,
We
okay.
have
So here
this.
bullish candle becomes the
Yeah,
breaker,
the
right?
bullish candle right here. This
Okay.
becomes the breaker. So we have all of this lining in the same place. 4-hour wick, 1-hour wick, 15-minute breaker, 15-minute wick, 5-minute breaker, 5-minute wick. All of them in the same place, which means that's a good area for you to look for buys, right? Wait for the confirmation. Okay, wait for the confirmation. What's the confirmation you need? A QM inside of this. Then you're buying it. Okay, then you're buying it. So yeah, this is all I do. Is it clear? Let me know. Yeah, right? Yeah, if you have any other questions, you can just hit me up. No problem. Okay, you can just send me your charts or anything. So when I see the message, I will reply. Okay. So yeah, this is it. I hope everything is clear. Yes.
Yeah.
Okay, bro. Then that's it from me.
And we can use
Yeah.
this
So everything's fine, right?
any
Yeah.
time frame, right?
Any
Instead of
time frame.
using the 4
Okay.
hour as a major time frame, for
Yeah.
intraday purposes, uh,
Okay.
can I use 50 minutes as the major time frame and 1 minute for the entry purposes?
Yeah, you can do that. Okay, but keep
Mhm.
always make sure you have the higher time frame perspective in mind. Okay, because the higher time frame is what gets respected. Okay, because like that's the thing, because you can just keep on buying this thing. Now let's assume you're not looking at the 4 hour time frame, but we know that this is the trading range on the 4 hour, right? And the weekly point of interest was somewhere around here. Now let's say you're only just following the 15-minute thing. So price is going up like this, and you're trying to buy with every single move. So let's say from here to here was the trade in range. And let's assume now price has tapped into the weekly point of interest. And you're waiting for a buy right here after the internal range liquidity get cleared out and you get stopped out. Why? It's coming from the high time frame. That's the thing. Okay. So pay attention to where, like, yeah, where price is coming from. Okay. Always stick to the higher time frames. That's what I can tell you. Okay. You can trade with the 15-minute, but it's risky. It is risky. Okay. Yeah. That's it from me then. Everything's fine, right? I hope everything is fine. Yeah.
Yeah, fine, fine.
Okay, bro.
So,
Like, yeah, if you have
that's
any
all
other,
for
yeah,
this.
yeah, if you have any other questions, you can ask me while backtesting. I'll add you to a private group. Okay, I'll add you to a private group, and yeah, if you have any other questions, you can ask it there. If I when I see the messages, I will reply. Okay, or else just send it to me. No problem with that. Okay, so everything made sense, right? I hope everything is clear. Yeah.
Yeah, perfect.
Okay. Yeah. Then that's it from me.
Mhm.
Okay.
And
Then so
which broker are you
yeah,
using?
like I'm using the FTMO service when I have my own live account that is from IC Market.
IC markets. Okay, okay.
Yeah, I see market because the spreads are low. So you can even on FTMO the spreads are low. So it's not gonna be a problem. Okay.
Okay.
Yeah, well, then that's it from me. Have a good day then.
Okay, then
Okay.
thank you so much.
All right, bro. So you got something out of session, right? I hope everything is clear. Yeah.
Hmm? It's not
Like
clear.
you understood this, right? You
Yeah,
understood what I taught you, right? Yeah.
yeah, of course.
Okay, bro. Okay, bro. Then that's it from me then.
Okay, then
All right, bro.
meet you
Have a
in
good day then.
a private group or on a private chat.
Yeah, bro. Okay, bro.
Okay,
See you
just
later then.
backtest
Bye
please,
bye.
and we'll
Yeah.
forward you the charts.
What, bro? I didn't hear you. What's that?
um, I will backtest it and will forward my charts to you.
Ah, yeah, yeah. No problem. Yeah, yeah. Backtest and send me the charts. Okay. All right, bro. Okay, then. Have a good day then. Bye bye.